Hello, my dear Chartered Accountant friends, seniors, and members. I am Hemraj Satyanarayan Joshi and moderator for today's session. Good evening and very warm welcome to this special webinar on the subject Comprehending the Commodity Derivative Market, which is arranged by Committee for Financial Market and Investor Protection, that is CFMIP of the Institute of Chartered Accountants of India. Friends, today is a historic day for all of us. Our country, Bharat, under its presidency, is hosting the G20 meeting at New Delhi today with the theme of Vasudev Kutumbakam. And on the same day, we are also gathered here to discuss and learn about this new and important topic. We will have with us our chairman, sir, CS Nanda, sir. I will also ask him to provide his keynote address. Apart from chairman, sir, we have our two learned speakers, Miss Seema Nayak, Chief Compliance Officer from NCDX, and Mr. Avinash Mohan, again from NCDX. Sir and ma'am, I welcome to you for this important session, and thank you for accepting our invite and to be a speaker for this session. Friends, India is one of the largest derivative market in the world. However, the much of the focus has been on the equity derivatives, where stock exchanges like BSE and NSE occupies an important part in the overall market. In a country like India, where the agriculture and commodity trade are to a large extent, a thriving commodity derivative market is of a paramount importance. Sorry. Over the course of today's discussion, we shall try and cover, with the help of our speakers, the various topics related to commodity derivative market, like basic understanding of commodity derivatives, history of commodity derivative market in India, to understand the differences between the financial and commodity derivative, structure of the market ecosystem, how these markets are important for us, why are these markets are required, what are the practical use cases of such market and the various scenarios, how these markets are adding value to the overall economy, and what are the overall challenges that what we have for the overall ecosystem of such markets. Now I move on and introduce the speakers for this session. We have with us Ms. Seema Nayak, Chief Compliance Officer from NCDX. She's having over 2 decades of experience in the securities market, spanning various roles. She has a very rounded perspective of the regulatory framework and environment. She is an MBA who started her career with the OTC Exchange of India and then served the NSE for around 16 years. At NCDX, she currently leads the team for exchange compliance, membership, member inspection, investor protection, PMN, and enforcement. She has been associated with NCDX for 7 years. With this brief introduction, I welcome Seema Nayak ma'am for this session. We have our second speaker, Mr. Avinash Mohan, again from NCDX, who's MBA Finance by qualification and has worked for the major part of the for his professional career, spanning 23 years in the exchange business across various functional domains, spanning operations, technology, product development, surveillance and investigation, market intelligence, and enterprise risk. He has been with NCDX since 2005. In his current role, he heads the surveillance and investigation, enterprise risk, and cybersecurity function of the exchange. Sorry. I welcome Mr. Avinash Mohan for this session. Now, I request our first speaker, Ms. Seema Nayak, to start her presentation, ma'am. I request all the participants to post their question on the portal. We will take this question at the end. Over to you, Seema Nayak, ma'am.
Thank you so much, Hemraj ji, for the kind introduction. I'll share my screen. Kindly confirm if the same is visible.
Yes, ma'am. It's visible now.
Thank you. So first of all, thank you very much for this opportunity, to interact with the entire CA community. It's a pleasure to be with you all. I also have to tell you that, unfortunately, there's a family emergency and I need to take a flight, so I may not be available for the entire session. But my colleague and friend Avinash will be there and he will be able to, take up every question that you have. I'll try my level best, but may or may not be possible. Moving on straight into the presentation. Are the slides changing for you? Yeah. Okay. So, well, this part, I think, not much requires to be said. I think each one of you is completely aware of the fact where we stand. In India, agriculture sector is a very critical component of the entire economy. Of course, there are those statistics, 60% of the country's population is dependent on agriculture for its livelihood. It accounts for around 18% of the GDP. India is world's largest producer of pulses, rice, wheat, spice products. And of course, there are those statistics on the screen which states that, we are not only the biggest producers, but also biggest consumers. All these statistics actually kind of lay the path for us to be the biggest commodity derivative markets. However, it is not so. You heard Hemraj ji say in the introduction that, while we are, the leading space, India is leading in the derivative space in the world, in the equity derivative space. But we are not in the picture at all when it comes to the commodity derivatives. In agri, while we have everything going for us, it is unfortunate that the potential has not been tapped at all. Be as it may, the statistics definitely indicate one thing, that agri sector is critical for financial inclusion, for the growth of Indian economy, which also explains possibly the protection measures that the government has, the MSP and the BIT, which we'll probably connect to. We will, during our conversations with you, Avinash and I will also touch upon the challenges and as to why this potential has not been tapped. But that we'll park for now and hold that for later. In all this context, where do the commodity derivative exchanges come? The key purpose of an exchange is price discovery, which implies that getting the right price to the farmer for his produce. It is evident that that is the reason why commodity exchange is the critical component of Indian economy, and more so, obviously, for Indian economy, because we are predominantly an agrarian economy. Like Hemraj ji mentioned, we are doing so well in equities. Now, what would be the reason, that there is this difference, this glaring gap between the equity and commodities? Well, the two markets are totally different. Let's take an example, and let's also understand when is it that the equity markets actually boomed. I would say the kink in the curve was when, the economies opened up, right? And institutional investors were allowed. And that is when there was a huge splurge in the market space, and post which the derivative markets were launched. And as they say, rest is history. What is it that changed in Indian markets? I think, the coming of SEBI, what NSE did for the Indian markets is brought in transparency. Let's take an example. Suppose you were in, say, some town in Patna, way back in 92, and you wanted to buy, say, 100 shares of any company, ABC Limited. The only way that you could do that is, you would go to your broker in Patna, who would then connect with some broker in Bombay, who would then, probably send his man to the ring and, buy those shares for you. And then the cycle would reverse. There were only 4 price points that were available to you. You would know the open, high, low, and close. So if you would have bought, you would have most likely to have bought around the high price. And if you had sold, you would be most likely to have sold around the low price. But you would never be able to confirm at exactly what price your deal would have happened. Come forward to 2023, and today, if you want to kind of buy a share, you can do it through your mobile app, and you know at what price it is being transacted. You can get that data from the exchange or from the broker. In fact, nowadays you yourself place the order, so you know it instantly also. So that's the difference that has been brought in. So the price transparency is what is very key. Now, in the commodity derivatives, one key difference is that, the physical markets are not electronic. So the settlement happens on the physical market price. In the equity markets, even the cash markets are traded on the exchange screen. So that makes the life a lot easier. And that actually gives a fillip to the equity derivatives. So let's see what are the other differences. Well, as you can see, the quality characteristics, they differ from, if you look at, let's take another product, soya bean. If you're looking at soya bean, the locations that it is available is probably Indore, Latur, Kota, Bundi. Each of these places, the quality specifications would be different, which means that the prices would be different. Now, this is a typical phenomena of the agri markets. In equities, wherever you buy the share from, it's the same. Again, the price is determined at one location, at one centralized location. That is not so in case of commodity derivative markets. So there are, of course, you can see on the screen the other things also. The end usage determine the prices, the seasons determine the prices. There is a storage cost attached to these, and not just the cost, it also means that it would have an expiry. And one thing that just cannot be taken out of the commodity markets is the physicality of the entire produce, right? So the physicality will always be there. So now that we know that there is this difference, let's kind of understand, how is the price determined in the physical markets? Because that will have a huge impact on the commodity derivative markets. The model of marketing agri-produce, the source of income to the farmers, is APMC. Each state is divided geographically into APMCs. The farmers are required to sell their produce via auction at mandi. APMCs are also known as mandis in their region. And, the traders require a license to operate in the mandis. The wholesalers and the retail traders and the food processing companies, etc., cannot buy directly from the farmer. Now, let's try and understand through a case study as to what is the lacuna of this model. Let's take something very nearer to our homes. In Maharashtra, we have around, I think, 300 odd APMCs, of which around 215 odd are operational. Let's look at potatoes, something that everybody uses and would have probably bought in last week or so. So potatoes are typically sold by farmers at APMC Vashi for 5 to 7 rupees per kg. By the wholesalers to retailers at 13 to 15 rupees per kg. But you and I buy these potatoes at around what? 25 rupees, 30 rupees per kg. I think the day before yesterday when I bought, I paid 30 rupees. So, 5 to 30, 6 times. That's the kind of profit margins we are talking about. 500%. Okay, you would argue that there is freight, etc., transportation. So let's just add another 5. That's the price that, farmer is getting. So even with that, the kind of margins we are talking about is huge. So what is one thing that is critical is, for us to have transparent spot markets, maybe electronic spot exchanges, which will definitely help reduce the transaction cost and increase the distributive efficiency of these market, through better marketing channels. How does how is the trade actually happening in the mandi? I had the opportunity to visit a mandi in Latur for chana, and you would be surprised that, or maybe you wouldn't be surprised. Trade is conducted. I had heard that, and we had already read that it is through an auction, etc. But there was this man who was, you can see on the screen a pile of. I think this is not chana, but a pile of chana was there, and then this guy comes और ऐसा हाथ में वो मुट्ठी में चना ले रहा है, and then he puts a handkerchief, and then we don't know what's happening, and the deal is done. So that's for transparency. So that's how the deal happened in the mandi, and that's definitely, the next person doesn't know what price the deal has happened. So it's completely opaque, and you compare that with equity markets, perhaps we'll get some of the answers that we are looking for. Again, from the retailer to the from the wholesaler to the retailer, it is through bilateral negotiations. So we did have, the nation did try to do e-market, national e-market limited, but that really didn't work out. Probably, I'm not sure if Avinash is going to take you through the REMS model that we have. We did experiment, because one thing that is that goes without saying is that you will need to develop the infrastructure for development of the commodity derivative markets. And since we are connected with the commodity derivatives, we tried our level best. So one of the things that one of our group companies did was try and build an e-market for physical mandis in Karnataka. And that is the REMS model. And I'm hoping that Avinash will cover it. And so I will not talk about it. If Avinash, if you aren't, please mention a couple of slides or a couple of, detail the REMS model also for the interest of the participants.
Sure, Seema.
We've talked about the inefficiencies, but quickly taking you through, there are multiple layers. Why did ₹5 become ₹30? That's because there are these multiple layers of people involved, artiyas and other agents, etc., which kind of adds on to the cost. And it adds to the price spread, right? So it is definitely a very inefficient way of the prices being discovered. Only the licensed traders can participate in the mandi, and the farmers can only sell in the mandi of their respective states. So these are restrictive practices, which we tried, the Farm Acts that we all know, the infamous Farm Acts now, which tried to kind of undo this, but it did not happen. Opaque price discovery, I've given you an example. Non-standardized quality and transaction procedures. Well, what is it that gives you the control over price? Whether it is a farmer, you, me, what is it that we do when we want control over price? We should have the capacity to, what is distress selling of flats? Because you do not have the time to kind of hold on to till the best offer comes. That's when you do distress selling, right? So it's similar for the farmers. What happens is when he brings his produce to the mandi, he's already incurred the transaction cost, the transportation cost, and he's already there. Suppose he has to leave there should be ideally an opportunity for him to leave the stock there to kind of sell it when the best price comes. And probably there is, but the facilities are so poor that his commodity is going to probably deteriorate, and he will probably end up getting lesser and lesser price. So the facilities in the current mandis are definitely below par. Plus, can you see this guy in the screen? You know what he is doing? He's assessing the quality of the produce. Okay, so that is how the quality of produce is being assessed. More often than not, I was surprised, at least in Latur Mandi, that they are right. But having said that, there is no standardized process for assessing the quality. So when we talk about the REMS model, you will hear that entire produce which comes in is first assessed. The quality parameters are then displayed on the screen, and the prices according to the quality parameters are also displayed on the screen. So the moment your assessing of the quality is done, you know what price you stand to get. And if you and of course we'll talk about the REMS model later, but that is how it should be. The storage facility is not being there is the biggest impediment. So the farmer has to, if he decides not to sell, he has to take the produce back. Now look at it from farmer's perspective. He's already already having this loan, and every single day is adding to the interest component. So he'd rather sell at whatever price it is he's getting, then take the produce back to get a better price on a subsequent day. And from his experience, I'm sure he knows that nothing is going to change the next day, right? So it is that's the thing that is happening in the physical markets, and that probably has some reflection in the commodity derivative space also. So why would the farmer trade on the commodity derivative markets? Even when I joined NCDX, it looked like an alien concept to me, because derivatives. You and I, at least I would have thought that it is complex for the farmers. Now, I'm happy to tell you that this myth was completely busted for me when I had the opportunity to interact with some of the FPOs who are actually doing trading in the commodity space. So one thing, one ailment of the Indian economy is that, the farming is very fragmented. So each farmer has these, very small pieces of land, which means that, his produce is limited, which also kind of does not give him the ability to bargain for the best price, right? If you have quantity, you will have the bargaining power, but these people do not have. So what is important in Indian space is farmer collectives, what we call FPO, which is Farmer Producer Organization. So these FPOs are who usually we do not have farmers participating on the platform directly for the reasons that I mentioned, but we have FPOs, and in fact, you would be surprised to know that the exchange itself has an FPO team, which means that we help create these FPOs, we handhold these FPOs. They need a lot of training to kind of initially, but I must tell you about this one farmer in the Unjha market, the Jeera market of Unjha, where, he was invited to kind of speak in one of our events and share his experience. And it was so heartwarming to know that, you have connected to the last rung of the nation. And I'll share some of the things that he said. He said the first thing that changed for them in Unjha when they started trading in the derivative markets is that they knew what was the ongoing price. Because see, if the farmer registers on the NCDX app, then we SMS him the prices. Or of course, if he has access to the website, you can always know what the price is. He says that, that gave us the first power. So when the Artiya used to come and he used to quote a price, we would say, but NCDX ka price to aisa hai. NCDX for them has become a generic name, they don't even pronounce the E there, but NCDX ka price aisa hai. So NCDX is a generic name in mandis, and I would really want you to visit one of the mandis and check this out. It's very, it's a matter of pride for all of us. So this guy, he says the first thing that happened is that it gave us the control over price. So I decided at what price my produce would go. And he says the other thing that has happened over the period is that now the Artiyas know that they can't just quote anything. So now they quote us in and around the NCDX price because they know we have this information. The other thing, what he mentioned is that, of course, this is the collective. So he says that the entire collective is now looking at other products where they may or may not be participating on the exchange, but they have this price point coming to them. So they know what the other products are also trading on. So if they are trading in smaller quantities, even that, they may not be actually delivering on the exchange platform, but, they kind of know the price. The third thing that he said is for Jeera, what they are doing is they deliver it on the exchange platform. You all be familiar with what we call EPI, early pay in. So if you deliver the products, then, margins do not apply to you, etc., etc. And I won't go into the technicalities of it. But what he is doing is delivering the product on the exchange, in the exchange warehouse, and locking his price for him. So see, future price he is locking. And the final thing that he says is that अभी हम क्या उगाएंगे ये डिसाइड करते हैं जब हम NCDEX का फ्यूचर प्राइस देखते हैं. So you know, one of the biggest ailments of the Indian farming is rear view farming. So how do I explain it to you? In Chennai floods, which was the year, I can't remember. You remember those Chennai floods that we had? And in that year, the tomato prices, of course, recently also we had a tomato price hike. But that year, the tomato prices, especially in Chennai area, really skyrocketed. And so what did the farmers do in the consequent year? Everybody started, growing tomatoes. And your guess is as good as, you could guess what happened next. So the price of tomatoes really fell down. In fact, the farmers found it, costly to bring it to the mandi. So they started destroying their product. So, this boom bust cycle is something that will happen. But, if you do rear view farming, you look into the past prices and grow today, then it's not really going to help you. You have to always, that's what the future prices also help you to decide what you need to grow in the future so that, you can meet your ends. So it's a myth that the farmers do not understand the derivative markets. You should really hear this guy, and maybe one of us can share he has done a lot of videos for us. So we can share one of those videos with you. You should hear him. In fact, I told you that we have an FPO team, and this FPO team now has realized one thing, that, when a FPO talks to the farmers, we are more likely to create an FPO than we talking to farmers, because, they understand each other's language, so to say. So the farmers are participating in the markets, and we also have multiple examples, but in the interest of time, I'll hold my horses there, and one example is good enough. Maybe if you want to hear more towards the end of the session, one of us could kind of talk to you about other experiences, some in maize market in North India, which was also very amazing. What also happens is, when the farmers start participating, the warehouse infrastructure also starts growing in that region, because the farmers need the place to kind of deposit. So the warehouses will come up. Similarly, the assaying facilities will also come up. So, the entire infrastructure suddenly starts developing. So in a town like Unja, and you should see Unja Mandi, it is like, it is like a corporate office. It's so clean, it's so organized, it's so disciplined. They have an auditorium, whatnot, that kind of a thing. So the entire scene changes when, you kind of start participating in the markets. We've seen that in equity markets, but it's very, very painfully slow in the commodity derivative markets for multiple reasons. And we'll come to that when, Avinash will speak about the challenges. So I think most of these points I have covered. Finally, I would say, these are the reasons, why are we here today is one of these reasons. Unfortunately, and I'm not very proud of telling you this, but before I joined the commodity space, to me also, it seemed that if you know equities, you can do commodities. In fact, it's the opposite. If you know commodities, you can do equities. And commodities, because of its nuances, is a little different from equities, but it's very, very interesting. In fact, while we all feel that we are not participating in the commodity markets, something that my grandmom said, kind of, when I told her that it's difficult to explain to my grandma, as to what work actually I'm doing. So I kind of hesitantly told her that, I'm in this commodity space. So I told her I'm in the agri-commodities space. So she said something like buying and selling. I said, yeah. So I was trying to explain her the future. And you know what she said? Oh, it's like what we do, what we used to do. I don't know, all of you would have, if you go back to your ancestral houses, you have these granaries, these big tub-like things on which they used to store grains and all. And so my grandmom says, so that's what we used to do, we used to kind of store when it is available so that we can use it when the prices go high. So we had we had a room in our ancestral, we have a room in our ancestral house where we don't no longer store, that's another thing altogether, but where they used to actually store stuff like this. So this is a concept that is not alien to us. However, the potential that this market has, and to tap the same, I think we really need to kind of do a lot of awareness sessions, we need to do the awareness sessions not just for the users, but even for the government, because, it's very easy to kind of make the derivative markets the scapegoats. And we've seen it happen time and again, most recently being the banning of 7 products that the government did. So these 7 products were banned apparently for no reason, so this is something that you will never ever see in the equity markets. Have you ever heard of equity which is being traded being suddenly banned? It never happens. In fact, I think it would create a furore, right, in the markets. But that is something that has happened to us again and again, right from the very beginning. We've had this history of product bans, and then they come back again. And believe me that, once even when we start a new product, or when a product comes after ban, the kind of efforts that need to go into it are double than at the time of launching, because people have been hit on the hard side when the product was suddenly banned. So like one of the traders told me, "Doodh ka jala jhaas bhi huk ke peeta hai." So that's what happens for us. And it's a tough space. We really need the support of each one of you. We need you to understand the criticality of these markets. It's important for everybody in the country to understand the criticality of these markets. Well, these markets can, are primarily for hedging. And unfortunately, you would probably be advising many of the companies, etc. But you wouldn't see many of the companies actually hedging on the exchange platform. In fact, it is a mandate, SEBI mandate, that you need to disclose in your balance sheets as to what part you are hedging, but they do not mandate hedging. RBI also has a regulation which they passed in 2015, where they said, they issued an advisory that you hedge, but they didn't mandate hedging. So we've seen companies getting closed because they were not hedged. Ruchi Soya, I can go on giving examples, right? So why would you not advise your corporates, the corporates that you're working with, to hedge? They are all doing the hedging for currency, and that they do without even, it's kind of second nature to them. So why wouldn't they do for their raw materials? So, these kind of things are the, we want this session to be thought-provoking in those aspects. We also do a lot of sessions with the government so that they understand, that their actions are not actually helping, but destroying. And banning is, in fact, a retrograde step, and taking us back rather than going into the future. We are refusing to learn from the history of world markets, and we are wanting to create the history all over ourselves over and over again. So it was with these intentions that we wanted to kind of interact with you today, and to bring to you the criticality of these markets, how it touches each one of us in our daily lives. So with that, I'll close my small session and hand it over back to Himrajji.
Thank you, ma'am, for such a good start to this session. In just half an hour, you covered the market in detail. I'm aware that you need to leave. You have some personal exigencies. But just one point, if you can throw some light. You're handling the important function of compliance at NCDX. What kind of role chartered accountants can play in the overall journey of the commodity derivative market, or the growth of this market? If you can throw some light on that, it will be really helpful.
So from the compliance perspective, or from general perspective?
From compliance perspective, and then on the general perspective. So
from the compliance perspective, clearly, chartered accountants are very connected with the entire industry through our stakeholders, be it the brokers, mostly through the brokers. We obviously do not have the listed companies, but we have the other stakeholders. We have VCPs, we have institutions who trade with us, who hedge with us, etc., etc. So let me take each aspect one by one. So when it comes to the brokers, each one of you who works with the broking space will agree with me that it is not an easy space anymore. The compliance is increasing, and I'm not exaggerating when I say it is increasing by the hour, not by the day, right? So it's difficult to keep up with the compliances that are happening. And therefore, it is very, very essential to kind of keep your client, keep the broker clued into what is happening. And we do a lot of compliance sessions, and it is, if you need a compliance session from us, if your client needs a compliance session from us, we have a provision in the website wherein you can actually make a request, and we'll be happy to do it. So the compliance, and that's a different session altogether, right? So we could even do a session on the compliance requirements that are there. So there are multiple things that have come up in the recent past, and the things are going to only come up more and more, whether it is the upstreaming of clients' fund, which was the most recent aspect, where it is the multiple audits that are required. The internal audit requirements are undergoing a change. If you're not making the observations in the internal audit and the exchange or the SEBI gets the same gets the observation, then the reprimands are sent to the chartered accountancy firm. Those kind of things are completely avoidable. So I think there is a lot of scope for us to work together. Some of it is fair. I even agree that some of it is probably unfair. So, maybe we could work together towards building a better, stronger regulatory framework. So one thing that I would like from all, the CA stakeholders is to kind of participate in the rule making. In pointing it out after the milk is spilled is not really helping, because then the penalties are already levied. It's beyond us not to levy penalty, right? So therefore, I think a little bit of working together so that we could help create a better framework. And I have had some of the CAs give such brilliant ideas, because you are at the ground level. You know what is happening. You know what is practical. You know what is impractical. It needs to be brought to the fore, interact with the regulators, So we should have a tripartite kind of a forum where the exchanges, the brokers, and the chartered accountants can together build some better framework. You all understand the market so well, and your contribution could be immense. As regard the other stakeholders, and I'll club that all together, the part that I mentioned about, the hedging part, these people are trading on, they're not trading, they're mostly hedging on the exchange platform. So the ones who are not hedging are the ones who require to be pushed towards hedging, because, that's definitely a risk mitigation measure that, and it's a must in today's world. The prices are so volatile, and commodity prices have around 30% volatility, which is like really, really high. Why would you not hedge your commodities? And I think that is something that we've been somehow we've not been pushing. And when I see the international firms, for them it comes so naturally. When we visit, the US or the UK firms, they are hedging is a part of their risk management framework. For us, it is not. And I think there again, you can play a very big role in kind of advising your clients accordingly. I hope I've answered your question.
Yes, ma'am. Yes, definitely you answered the question. Thank you, Seema ma'am, for your session. Now I request Mr. Avinash Mohan for his session. Avinash ji, over to you.
Hi. Thanks, Imraj. I hope I'm audible at the moment.
Yes, you are.
Yeah, just give me a minute. I'll just share my screen.
Sure.
So could you just let me know when the slide deck is visible?
Yes, it's visible.
Okay. Thanks. Right. And again, thanks to my colleague Seema. She covered some of the topics in a very lucid manner, very simplistic manner, and I mean, kind of made it easy for me to carry on from where she's taken off. Some of the things that she has already covered, I might be repeating, but there could be some difference in the way that I bring about some perspectives, and hence the repetition. So forgive me for that. I'll basically just setting the context at this point of time before we start off and go ahead. What we're trying to understand out here is a little bit about the commodity market, but more importantly about the commodity derivatives market. And these are two completely distinct markets, and we'll try and go into the modalities of each of them. So the commodity market in India per se is something which is very local, very state specific, and like Seema mentioned, they base in the APMC mandis across the country. A commodity derivatives market, on the other hand, is something which is more pan-India market. Something like, say, an National Stock Exchange on the equity side. Similarly, you have NCDX and MCX, which are commodity derivatives markets as such. Historically, as an exchange, NCDX has always been very focused on the agri side of things. We have made various ventures into the non-agri side as well. But typically, our forays have all been with the conscious view been on the agri side, because I think that's where we add most value with respect to the Indian economy. But this is a session on commodity derivatives, and hence we will be a bit mindful to ensure that we cover both the agri as well as the non-agri side of things, so that the people who are listening into this video get a sense of how commodity derivatives are working in India and what are the nuances of these markets. Again, we shall touch base on some differences between equities and commodities from a structural perspective this time, and then see how we can use these markets to how these markets are used by the various participants across the country. So we'll look at some use cases. So this is a general synopsis of things that we shall cover over the next hour and a half or so, and hopefully that can add some value to the people who listen into this this particular session. So just let's get down to basics. I think Seema also brought about this distinction between the commodity market and I shall try and take it up. What's the difference between these markets and the derivatives market? So if you look at these markets, it's kind of synonymous with how any APMC functions across the country. This picture really gives you that story. A few people across what is locally called a dher of commodity or a pile of commodity, and there is no scientific assaying or grading which is taking place. People literally chew into the grain or chew into the oil seed and then decipher the something very technical like the oil content in the oil seed. So if you go to mustard in the months of March and April, if you go to Jaipur and you go to any of the mustard mandis, people will be chewing into the fresh mustard seed which comes into the market, and then very confidently giving a judgment on whether it is 37.5% oil content or 38% oil content, which sometimes even the machines don't give you the right answer to that extent. So to a large extent, the price which is derived is based very much on the judgments of people. And in a small community like a trader community in any APMC, where participation is really limited to the extent of licenses already handed out in that particular mandi, more often than not, you see a bit of collusion happening and the prices being set not always to the benefit of the farmer. So that's something which is very typical of any physical market across the country. So these are the main characteristics, right, of the physical markets. If you look at it on Indian basis, you have APMC pretty much, you have multiple APMCs in pretty much every district in the country. So a farmer from a village normally takes his produce to the APMC which is closest to him. And like I mentioned, each of these APMCs have a set of traders, and you need to be a licensed trader in that APMC to come in and participate in the auctions out there. The pricing structure, the way the prices are determined are basically very opaque. Like Seema mentioned, each of these markets have their own nuances. So some places it might be open auction, some places prices might be determined by some handshakes happening under a handkerchief. So each market has its own nuances out there. Participation is limited to the set of participants out there, and the whole governance of these markets is a subject of the state. So it's not really a central subject. Each of these markets have their own rules depending on the state at where they are located. Like I again mentioned earlier, it's not always the best structure which serves the interest of the farmer. I mean, it's something which has been there in place for a long period of time. It's not always it's easy to criticize things like the structure at an APMC, but the alternatives of not having an APMC are equally detrimental as well. So we have seen some states where the APMC structure itself is not around, where farmers are even more compromised and their interests are even more compromised to that extent. So it's not really the best structure to serve the interests of the farmer, but at least he has some nodal point where he can take his produce and where he can expect some realization for the crop. And these are typically spot markets. So this is the main distinction between a derivatives market and a physical market that you see. So these are spot markets. Produce is got to the market, they are sold, transfer of ownership takes place virtually instantly. Payment takes place either the same day or next day, but it's virtually instant. So there is a definite timeline within which the entire transaction is completed. In most markets that we have seen, it's limited to the same day or the next day. So these are spot markets. The derivatives markets, on the other hand, are not spot markets. They're anything but spot markets. Most of the contracts that we are having for trading on our exchanges, they are for a duration of 4 to 6 months at the time when they are set out or they are listed for trading. So typically, in how markets in the agri side are structured in India is that you have contracts expiring almost every month of the year, except for those periods when you do not have the produce coming in the market because of the low availability of the agricultural commodity in concern. The non-agri side, on the other hand, in commodities like steel, you have contracts throughout the year. That's 12 months of the year you have contracts. If you look at the energy markets, again, you have typically contracts which are launched for 12 months of the year. However, if you look at the non-agri side, especially energy, base metals, precious metals, there is a strong correlation of these contracts with the international contracts. And that's primarily because of the fact that India is not really a price setter in these markets. India is more of a price taker in these markets. So if you look at gold and silver, we are among the largest consumers in the world for these commodities. Historically, we've always been very sophisticated in the way that Indian households consume gold. India uses gold as a part of their savings portfolio. Typically, every household has some or the other savings in form of gold. And over the years, these have become even more sophisticated with options like ETFs and sovereign gold bonds, which are available today. You need not only go for physical gold. Yet, in spite of all the presence that India has in this market, India is not really a price setter in this market. It's only the international markets which really set prices in these markets. Similarly, in all other commodities which are available for trading on the commodity derivatives scene in India, you have gold, silver, you have some base metals like aluminum, nickel, copper, zinc. Most of the prices are inspired by or have a very close correlation with the international exchange prices. And in many cases, you also have collaboration with international exchanges wherein the contracts are kind of cross-listed. So the price settlement happens basis how the international contract settles. This is especially true in energy, where the prices are highly correlated with the NYMEX prices, and natural gas and the WTI contract, which is very quite liquid in India, not very liquid. So there the prices are completely dependent on how the international markets settle. But if you look at the agri scene, pretty much all the contracts have a very domestic price discovery, because the way Indian economy trades with respect to agricultural commodities, even in commodities where there's a lot of global presence, for example, like wheat, soybean, soya oil, any other edible oil, sugar, maize, the large crops have very domestic price discovery in place, because as an ecosystem, we are slightly protected, or insulated rather is the right word, from the global economy on account of the various rules that the government puts in place with respect to exports and imports of these commodities. In terms of edible oil, we are slightly more in sync, because to a large extent, we are dependent on external sources for our domestic consumption. So we import a lot of crude palm oil from Malaysia. We import a lot of soya oil from countries like Argentina and Brazil. Sunflower we import to a large extent from countries like Ukraine and Russia. But in most other agri commodities, we are highly domestic with respect to price discovery, and hence we feel that the economic value of an exchange in the agri space is much higher to an economy than in an ecosystem where typically price discovery is taking place somewhere else, and we are merely taking or using those prices from the international platforms. Uh, Derivatives markets, like all markets that we know about, NSE, BSE, any of the other exchanges, we are all an anonymous trading platform. So you do not really see your counterparty, you do not really know the counterparty. There's an electronic trading screen through which the transactions take place. And that's more or less the safest way for transactions to take place, because when you do not know your counterparty, there are very few there is a limited chance of collusion taking place between either the buyers or the sellers and manipulating the price in a particular direction. So that's one of the benefits or unsung benefits of electronic trading platform, the fact that you don't know who's on the other side of the screen as such. Again, I mean, there was a time when derivatives exchanges, even on commodities side, were regional in nature. So even in Bombay, I don't know, participants from all over the country might plug into this at some point of time. But in Bombay, you had an exchange called Bombay Cotton Exchange, which was located in a station in Bombay called Cotton Green. The station itself was named after the cotton exchange out there, and this was one of the earliest cotton exchanges in the world, in India at least. Similarly, you had exchanges all over the country, like there's a pepper exchange in Kochi. There was an exchange for castor seed in Ahmedabad. There was exchange for kapas in Surendranagar. Like you had regional exchanges all over the place before the 1990s. You had the Calcutta Stock Exchange, you had the Delhi Stock Exchange, you had the Cochin Stock Exchange, for example. All of them have later subsequently shut down, and today you only have BSE and NSE. Similarly, in the derivatives, commodity derivatives scene as well, all the regional exchanges have given way to the national exchanges today, which is primarily MCX and NCDX with respect to commodities, and also NSE and BSE as a minor presence in these markets as such. So there's hence all the participation is pan-India. The entire country can participate on one trading platform, and the wider the trading platform, the deeper the participation pool in any contract, the less chances of the price discovery being compromised or being susceptible to any kind of manipulation. For the last 8 years, these markets have been under the regulator SEBI. Erstwhile regulator for these markets was an entity called the Forward Markets Commission. And since 2015, 2016, the merger of these two regulators has taken place. And from 2016 onwards, SEBI has completely taken over the regulation of these markets. The reason we say that it's a sophisticated regulator is because, SEBI looks after a wide array of asset classes today, right from everybody knows that they do the equity side of things, and they've always been the regulator for equities, but they are also a part regulator for currency derivatives. They also look at interest rate derivatives. They look at commodity derivatives. So they have a wealth of experience across asset classes, and of course, very sophisticated tools for regulation as well. And the benefit of the rule making in one asset class percolating down to other asset classes is something that we have felt over a period of time. Also, what has happened is that after SEBI has taken over, gradually these markets have been opened up. More instruments have been brought into these markets. Prior to 2018, we only had futures which were available for trading. And now we have had options introduced. We have indices as well. Pretty soon we might see more sophisticated instruments like weather derivatives also coming into this platform. Hence, the markets have only become better, more vibrant and deeper as such. And the regulator has put in every effort possible to increase the reach of these markets. This, like any other exchange in India today, is a completely neutral platform. The ownership of the exchange has nothing to do with the trading on the exchange. And of course, there is a very strong oversight in terms of the regulator, and also in terms of various other regulators as such also, which regulate these markets. For example, while the trading on the platform is regulated by SEBI, A commodity derivatives platform is to a large extent also dependent on warehousing. And warehousing as such has an independent regulator in terms of the Indian markets called WDRA. So you have a joint regulation of these markets taking place. The trading is regulated and under the aegis of SEBI, and the warehousing regulator is WDRA. And future date contracts is something that I already mentioned, I already spoke about. Derivatives is all about giving a window into what's happening or what's likely to happen into the future. These contracts are places where participants across the country contribute their views on supply and demand, how it's likely to pan out over the next few months or the next few years. So it's all an integration of supply and demand outlook for the future. And this outlook can be used by multiple people. So one of the best use cases for these markets is that participants use it to hedge their risk. And we'll come through at some point of time how participants use it to hedge their risk. But even people who are not participating in these markets, just by looking at what is the 3-month down the line future for a particular contract or for a particular commodity, you are able to be in a better position to pan out or plan out your business activities or your activities as such. So, for example, a lot of bureaucrats look at this data to have a sense as to how inflation is going to pan out over the future, especially with respect to commodities which are listed on these platforms. So these platforms very often act as future contracts always act as a mirror as to what's going to happen in the future. And sometimes, I mean, the pictures which are shown by the mirror are not very attractive. Maybe it does not, I mean, is not very pleasing to the eye. And at times, as such, we have instances like Seema mentioned, we have some contracts which are delisted at this point of time. That's primarily because what you have done by delisting the contracts is just shoot the messenger rather than try and interpret what the messenger is trying to tell you and augment your own requirements by looking at what's being told. Shooting the messenger is a bit of a retrograde step, but this is something that happens at various stages of evolution of these markets. It's not something that's happened only in India. It's something that we have interacted with various other colleagues across different jurisdictions across the world, and it's a kind of a painful evolution for these markets, which it's not necessary that every economy does go through it, but at this point, at least, we are going through it. So that's something which is there. Now, if you look at the history of these markets, in the current avatar, we know that these markets have been around. NCDX, MCX, for example, we've been around from around 2003. So it's almost like 20 odd years that we've been around. December 2003 was when we first started trading. So we were just about 20, just entering into our early 20s as such, just about teenagers from an age perspective. But these markets have been around for ages in India. So the first exchange in India, derivatives exchange in India, was the Bombay Cotton Trade Association, which was launched way back in 1875. So we have a very long history of derivatives trading in India. I mean, even oilseeds, which have now been banned in December of 2021, we first started trading in the year 1900s. Gold and silver was something which we started in 1920s. And then thereafter, we started seeing some of the other restrictions on trading taking place. So 1939, which more likely than not is on account of the Second World War, where there would have been an imperative need for cotton across the world. Cotton derivatives were banned. And then there was a regulator after independence who was set up under the FCRA Act was passed, and then the regulator was set up, the Forward Markets Commission. Again in 1955, then on account of the fact that gold was the anchor on which your currency was pegged, gold and silver futures trading were banned. And then in 1966, as we went through a phase of nationalization wherein a lot of major companies as well as banks were privatized, taken over on the public sector, a lot of trading in futures commodities was banned at that point of time. Selective bans were removed in the mid-80s, and subsequent to the 1992 liberalization, the government looked at these markets and considered removing the ban on derivatives trading. But it's not until 2001, 2002, wherein the government really came out with its intent to allow national level exchanges to come up, and licenses were issued in 2002 for at that point of time 3 national level exchanges to set up shop. And December 15, 2003 was when these exchanges first started futures trading. 2007 was when we moved from cash settled contracts to contracts which are backed by physical delivery. So that's when the actual transition to physical delivery as a mode of settlement really took place. If you look at the equity comparison, equity futures and options in the current form commenced trading somewhere in 2000, 2001. And even till date, most of the, of course, index options will always be settled, cash settled. But even the stock futures, they only became physically settled about a few years back. Till a very long period of their existence, they were cash settled. But commodity derivatives have been physically settled almost for the last 16 odd years that we've seen physical settlement in commodity derivatives, which is much more difficult than having physical settlement in equity derivatives, merely because of the fact that commodities are really huge, bulky things, and it's not easy to do a physical settlement of it. I mean, just looking at the size of a 10 metric ton chana lot for delivery is something which people sitting in urban areas are unable to really comprehend. And it's very easy to buy 10 shares of 10 lots of Reliance or 10 shares of Reliance or whatever, even 1,000 shares of Reliance doesn't make a difference. But buy a 10 lot of chana or 10 metric ton lot of chana or 100 metric ton lot of chana or 1,000 metric ton lot for delivery. There's a huge, humongous difference in terms of the complications involved in handling that size of delivery, the logistics involved for that, etc. Subsequently, 2015 was the next big step that happened in these markets. You had the merger of SEBI and FMC, and 2018 options was launched in commodity derivatives, agri, non-agri. Options today are very successful or reasonably successful in the derivatives market, commodity derivatives market, in some of the non-agri contracts like crude and gold. Not so much in the agri space, because some of the large contracts where options were doing well have been delisted at this point of time. But we expect that over a period of time, options are the instruments which will really pick up in terms of popularity in these markets. I mean, and that's primarily because, especially in the commodity ecosystem, there's a rich history of people understanding options and people trading options as such. Just sorry, just give me a second, please. I'm very sorry for this.
No worries, no worries.
I'm sorry, Hemrajji, I'm alone at home and I have no control over the doorbell. I'll just put it off. Yeah, apologies for that. So I was mentioning that options are something that we are very bullish upon. We have a very rich history of trading in options. Even today, we are among the largest exchanges in the world in terms of options trade. Is based out of India, that's the National Stock Exchange. But even years ago, when we used to travel to tier 2 towns in India, people were very familiar with options, although they called it by different names. Like, for example, in Bikaner, they called it Jotha. Each center had their own colloquial names for options, but everybody understood what an option contract is. And hence, we feel that once we have large commodities which are available for trading, options is something which is very easy for it to pick up in this economy. Now, this is just a perspective of how these markets are spread across the world. Everybody knows or has heard of exchanges like the London Metal Exchange. Very recently, about 2 years back, there was a fiasco in the nickel contract out there. People have heard about Chicago exchanges, that CME and CBOT. CBOT has been taken over by CME, in fact. And you have the Intercontinental Exchange as well. So these are some of the large exchanges which pretty much everybody is familiar about. But the real large exchanges in the world on the derivatives, commodity derivatives side are the Chinese exchanges today, because they really dominate the space as far as trading is concerned. And one of the reasons for that is that, I mean, although if you look at the evolution of these markets, this next stage shows the evolution of these markets. If you look at it from a time scale perspective, 2003, 2004, Indian markets and Chinese markets were virtually at the same size. In fact, in 2006, NCDX itself was the sixth largest exchange in the world as far as agri commodities go. And 2007, 2008 onwards, Chinese exchanges have really taken off, and they have virtually exploded. And today they have overtaken even the American exchanges with respect to liquidity on their exchanges, on their platforms. And one of the main reasons for that is that in spite of the fact that they are a very highly regulated economy, the Chinese regulators are very mindful of the fact that they require continuity in these markets, and they require these markets to really thrive and develop. And rather than trying to control the prices by suspending contracts, as is often done in, say, India, what they have done is that they have got the state level entities to come in and participate on these platforms and really dominate or express the government's views with respect to prices through participation on these platforms. So the equivalent of, say, a FCI in India is some state level entity in China actually expresses the government's views by buying and selling on the Dalian exchange or the Zhengzhou exchange or any other exchange in China. And in addition to that, the retail participation also has picked up quite exponentially out there over the last few years. To the extent that today they are even allowing foreigners to come in and participate in their derivatives contract. This has been a very gradual opening where the foreign participation has been allowed only in the last few years, and that too only in selective contracts. But they now are opening up their markets even for foreigners to come in and invest. India, on the other hand, we did have a very healthy start to derivatives trading. Like I mentioned, in 2006, we really kind of exploded with respect to agri trading. Again, we had but again in 2006, 2007, 2008 was when the first time we were hit by suspension. Some of the pulses contracts were suspended at that point of time, Urad and Tur, and they've never been relisted on the exchange platform. Over the years, I think in the 20 odd years of history that we've had, we've counted ourselves around 19 times that contracts have been suspended in India. And that's not really a healthy environment in which a platform develops or a market develops. Because people who have been, like Seema mentioned earlier, people who have been very enthusiastic to start trading in a particular contract or start hedging in a particular instrument, suddenly when they are overnight see the contracts being suspended, they are the second time they become very wary of participating in these markets again. And hence very often you find that once a contract is suspended, it becomes very difficult to get back the kind of vitality and the kind of depth in participation that it had at some point of time. Yet we are hopeful that once we have a reasonably stable policy outlook towards these markets, we should see very healthy participation going forward. And from an advocacy perspective, we have done pretty much everything that we can, right from getting a lot of academics to come in, look into the way these markets function, study the trading on the platform, on the exchanges, and then give their verdict on whether these contracts are actually in any way leading to inflation or not. So there have been unequivocal statements given by and studies put out there by various academics across the board, stating that these markets are in no way relating to any spike in inflation at any point of time. Secondly, we've touched base with almost all the bureaucracy and government that we can, and pretty much are confident that the change in mindset with respect to these markets is now underway. And the next time we see some of these contracts listed again, we should see a much more stable policy outlook towards these markets than was prevalent in the years leading up to now. So that's something that we are hopeful for. And there's no reason why India should not go back on the growth path and stand shoulder to shoulder with, say, the Chinese exchanges or the US exchanges in terms of size in the years going ahead. Because that's especially something that India deserves, because I mean, what, with 60 odd percent of the GDP being dependent on agri, especially, at least in these markets, you need to really have a very healthy and thriving derivatives platform. If you look at it on a global basis, the share of agriculture has been increasing over the years. So we don't have data for 2022. It will be out sometime soon, I hope. But if you look at it over the years, the data shows that the share of agriculture has been increasing. In spite of the fact of the volatility that we have seen in asset classes like energy, especially, we still see a very healthy share of agriculture in these markets. This has to some extent already been covered, so I'll just spend a couple of few minutes out here. One of the main characteristics of commodity derivative market is that the underlying supply of these markets keeps on changing during the year, and that's very different from equity markets. So in an equity market, for example, if you look at Reliance Future, it has a certain market cap, it has a certain number of shares outstanding in the market, that will remain stable throughout the year. It's not really going to change unless there's some kind of corporate action in the particular stock. But in any agricultural commodity, the supply keeps on changing throughout the year. So there's one phase when all the supply comes into the market, and that's typically when the harvest for a particular commodity takes place. So in India, you have two seasons, the Kharif and the Rabi. So if it's a Kharif season, the supply will typically come into the markets at some point around Dussehra or Diwali. And that's when you have the peak supply in the market. And then the supply keeps on diminishing throughout the year. And next August, September is the time when it's the lean season for that particular contract. There'll be very limited supply of that particular commodity in the year. So this kind of is very unique to commodity derivatives markets. Even in the non-agri side, if you look at energy, there are phases when the demand is at its peak. So if you look at the European markets, you see that the peak energy demand emanates around the winter months because they need a lot of energy for heating their homes, which is of paramount importance at that point of time. In India, the peak energy demand, or at least the peak electricity demand that we have seen, typically emanates in the months of the summer when we're trying to cool ourselves in the air conditions of our home at that point of time. So these kind of seasonalities are associated with commodities, be it agri or non-agri, which is not very often transmitted into the equity side of things. So even though a company which is listed on exchange might be a commodity or company, it's not really seasonal in nature as much as these companies are. As much as the commodity sector is. Yeah, I think Seema already spoke about heterogeneous nature of the commodity. Different areas have different qualities, and hence it's a little more sophisticated. In one more unique distinction between agri or commodity derivatives versus equity derivatives is the fact that commodity derivatives are settled on the spot prices, and the spot prices are not prices which are traded on the exchange platform. So on the equity side, what happens is that the Reliance future settles on the last Thursday of the month, and it settles on the price of Reliance, which is also traded on the same platform. So NSE Reliance underlying price is the futures price settlement on the last Thursday of the month of every month. But on the commodity side, you only have the derivatives which are traded. The physical, as I said earlier, is traded in various mandis across the country. So how do you settle a contract? So typically, the mode of settlement is compulsory delivery. So most of the contracts, the open interest upon expiry is settled through compulsory delivery. But yet there has to be a price for settlement, and hence a price is polled from the physical markets. So like you have this polling for instruments like MIBOR or erstwhile London International LIBOR rates, which were polled earlier. Similarly, you have a structure of polling commodity prices in the derivatives exchanges as well out here. And we poll from various physical markets across the country, and the last 3-day average prices for that particular commodity is used for settling the contracts. Now, contracts typically expire on the 20th of every month. In the equity side, it's the last Thursday for every month, or nowadays every day of the month, day of the week is also an expiry if you look at weekly options and weekly expiries as well. But the monthly expiry is on the last Thursday of the month. Similarly, we have monthly expiries as well, and it settles on the last on the 20th of every month out here. The unit, it's not, I mean, the trading lot differs from commodity to commodity, tick size differs from commodity to commodity as well. And that's pretty similar how it's on the equity side as well. So a commodity like Jeera today is priced at around 65,000 rupees a quintal. So one trading lot is around 3 metric tons. Whereas a commodity like, say, castor seed is around 7,000 rupees a quintal, and one trading lot is around 10 metric tons. So it varies from commodity to commodity. What's the local practice out there? So there's a lot of differentiation within the ecosystem as well. Like you have, and maybe I'll touch upon repositories and what they are when I look at the ecosystem as such. But you have all these participants. You have a repository, you have a warehouse service provider, you have an SAer, you have concepts like what's a basis center and additional center. The basis center is the center to which the contract is anchored. So, for example, if I look at the soybean contract is a contract which is anchored to the basis center of Indore. So when the contract finally expires, it's settled on the Indore spot price, which is pulled from there during the last 3 days of the currency of that particular contract. And then you have additional delivery centers where also people can go and either give or take delivery through that particular center as such. And these centers can be anywhere across the country. So typically in a commodity like soybean, you look at the main growing areas, which is Maharashtra, Rajasthan, and MP. And within these states, you have the delivery centers which are located out here. So each commodity, you do a kind of a feasibility study to understand where it is grown, where it is consumed, which is the centers which are good to be marked as delivery centers. And accordingly, the contract design for these commodities is structured. Like I've mentioned multiple times till now, these commodities and this asset class is susceptible to government intervention. And it's not only agri, it happens on non-agri sites as well. So you, even with something like gold, you keep seeing duties being increased, and that leads to a lot of undesirable activities, like a lot of smuggling taking place. So right now it's like what, 10-15% customs duty out here. So these are markets where you do see much more interventions than what you see on the equity side. Equity side is more it's pretty liberal. There are very limited interventions taking place either by the regulator or by the government as such. But here you see a lot more participation from the government side in terms of making interventions in these markets. Now, what is the main reason why you have commodity derivatives markets? I mean, basically it serves two purposes. One is that it helps in price discovery, and price discovery for on a pan-India basis for the future months. So typically you see price discovery of 1 month, 2 month, 3 month, 4 month ahead futures taking place on the exchange platform. That is much more healthy price discovery than what you see in a local APMC, wherein each APMC has its own limited set of participants, and they might work on their own unique sub-regional supply and demand characteristics which are taking place at that particular day as such. But if you look at a derivatives platform, the entire country comes in and participates in one contract or a few expiry contracts, and that's where you see very healthy price discovery taking place. And these price discovery also leads to a lot of price transmission. One of the things that Seema spoke about was that the biggest benefit that these markets have given out is the fact that the farmer is much more educated today, or much more aware today rather than educated. Aware is the right word. It's very difficult to fleece him off his commodity today than it was maybe 15-20 years ago. That's because he has at his tips of his finger various means through which he can ascertain the price of at least the commodities which are trading on these kind of platforms. So price discovery and price transmission are one of the main benefits of these markets. And secondly, it's for price risk management. Risk management is something which is of utmost importance to the commodity ecosystem, because whichever area you are in, the margins in this ecosystem are wafer thin. So if you are in the agri side and you are buying chana and processing it and converting it into besan or to chana dal and selling it, or you're in the non-agri side where you buy crude and you refine it and sell it through your various byproducts, or even if you're buying gold and transforming it into jewelry and selling it, the margins in each of these are very, very, very thin. And the moment you are exposed to volatility, wherein you bought something, say you bought gold at 58,000 rupees, and the price of gold goes down to 48,000 rupees, you're suddenly sitting on inventory with a huge loss. So it's very difficult to maintain these margins and these businesses for the long term if you are not appropriately hedged on these kind of platforms. And hence, if you look at, I mean, there are companies in this, at least in the world, who've been around for hundreds of years, and the only reason that they've been able to survive in these markets, in the commodity ecosystem, is that they use these markets very efficiently to hedge their exposures. So it's always very important for any organization to have to be very cognizant of what is the risk appetite that you are willing to take. So it's not that you need not take risk at all. You can always take risk. You can always have a view on where the prices are going to go. But beyond a particular time, beyond a particular limit, exposing yourself or your organization to undue risk is an invitation to the disaster. And some of the names that Seema spoke about, some of the organizations that we have seen in this country itself, which have gone belly up, primarily because they have punted on the direction in which prices will go, rather than actually focusing on their own operations. So a commodity company, very often the core competency of that company is to buy a commodity, transform the commodity and sell it. So if it's someone can buy, say, soybean, crush the soybean, manufacture soybean meal and soybean oil, and sell these two byproducts. Or they buy cotton, separate it, gin it, then separate the seed out, crush the seed. There are various byproducts which come out through any single commodity. The whole transformation process is what the company makes money out of, rather than trying to punt on the price going up or price going down. That is best left to people who are able to manage that kind of risk appetite, who are really only in the business of taking directional calls on a particular commodity. But if you are an organization who's say a Wilmar, or say any sugar mill, or any chana dal manufacturer, your business is mainly lying in buying a raw material, converting the raw material, processing it, and distributing it and selling it. This is your core competency, and you need to focus on your core competency. Make sure that you have the cheapest cost of operations in terms of converting the raw material into end product, and the most efficient line of distribution to reach your customer. The moment you do this, then the only risk that you're exposed to, that's the volatility in prices. These are the risks which you need to ensure that you are mitigating through such hedging on derivatives platforms. So you should, this is all a volumes game. So the more and more churning that you do in terms of buying inputs and converting it and selling in outputs, the more is your income. There might be years wherein the prices move in your favor and you might make more money just on inventory. But there might be years where if you are not hedged and the prices move against you, you can literally wipe out your profit completely, or you can even go into substantial losses. So any sensible organization really focuses to a large extent on developing a risk appetite, ensuring that they stick to their risk appetite, and making sure that everything else which is beyond their risk appetite is appropriately hedged. So if you look at, I mean, I think a lot of chartered accountants will always look at the balance sheets and earning statements put out by various organizations. So one of the very large organizations, that's Adani Wilmar, which is a commodities company which has all their edible oils and attas and everything else. In their last quarter guidance, they have hinted to the impact that not having a derivatives platform to hedge on in the Indian markets has made it very difficult to maintain their bottom lines as such. This is the kind of this is the extent to which companies focus on these markets, and these large corporates who have an appropriate level of risk appetite in place are very well versed with the amount of risk that they should be taking and the amount of risk that they can offset by hedging on the exchange platforms. That's of utmost importance when we advocate in terms of risk management as being one of the main tools for the reason of these markets. And if you look at the entire ecosystem, right from the farmer to anyone who's involved in these markets, whether it's the government agencies like FCI who buy and stock huge quantities of wheat and rice, all the traders in the physical markets, the millers and processors, exporters, importers, I mean, any agricultural cooperatives which is buying material from farmers, pretty much everyone is exposed to the risk of prices moving against them. So anytime a farmer is holding a particular commodity, he's always exposed to the risk that the prices might crash when he's not yet sold his material in the market. And similarly, every leg of the value chain is exposed to these kind of risks. The very few participants in the entire value chain, that's your commission agents and to some extent your aggregators at the village level, who are not exposed to price risk. So hence every one leg of this value chain really ought to be participating in the derivatives platform. And in any mature economy that you see, even in Indian markets, if you look at some of our very mature contracts, you see that practically everyone comes and participates on the exchange platform. Now let's spend some time on just understanding the structure of these markets. To that extent, these markets are kind of very similar to equity markets. So if you look at parallel, this is how the commodity ecosystem look like. I shall also speak about the parallel equity ecosystem. So it all centers around the regulators. So we have two regulators. In the equity markets, you typically have only one, that's SEBI. But like I mentioned earlier, we have a very strong physical leg to our transactions. And hence, WDRA is the regulator for all the warehousing which is available in the country. Of course, you have the exchanges. You have 5 exchanges at this point of time. NCDX and MCX are the main commodity derivatives exchanges. But NSE and BSE also have contracts which have not yet at least taken off on the exchange. And there's a Metropolitan Stock Exchange as well. So these are the 5 exchanges around at this point of time. Clearing corporations are the entities who are associated with the exchange. For a very long time, they were almost synonymous with the exchanges. Today, most of them are independent as on their own. And each exchange typically has their own, like NCDX has its own clearing corporation, NSE, BSE has their own clearing corporation, as well as MCX. Then you have something called a repository, which is now where we are slightly different from the equity side, but it's kind of a parallel. In the equity ecosystem, you have something called a depository, where you have NSDL and CDSL. And these depositories erstwhile were set up by NSE and BSE at some point of time during the evolution of those markets, and now are completely independent, or rather quite independent organizations on their own. Now, similarly, you have repositories in the ecosystem, in the derivatives ecosystem. So you have NERL, which is where NCDX has a majority stake. So NCDX has kind of floated in sync with some other institutions like SBI and ICICI. And then there's CCRL, which is promoted primarily by MCX, BSE, and some other organizations as well. So these are the 2 repositories. So anyone having trading on the exchange platform trades through the exchanges, has a and in parallel, how in equity markets you have a demat account. In the commodity parallel, you have a remat account, and the remat accounts are opened with repository participants as they are opened with depository participants on the equity side. Now, each repository participant, so the remat account is where you have your accounting of physical stocks taking place. The repository is nothing but a repository of all physical stocks through which trading takes place and deliveries and deposits take place on the exchange platform. So it's not really limited to only exchanges, but repositories also host a lot of information about physical stock of, especially of agricultural commodities across the country. So any commodity, any warehouse across the country, it is possible for the stock to be rematted. That's in that sense, you are creating what is known as an ENW, or electronically negotiable warehouse receipt. And this is an instrument which is recognized by law. It has legal tender, it has legal validity. It can be used as collateral when you're raising finance through various banks or NBFCs. So that's one of the benefits of having a repository and the repository ecosystem associated with it, that every material which is deposited into the warehouse, you get an electronic credit for it. The electronic credit comes into your repository account, and once you have an electronic credit, it becomes very easy for you to transact. Erstwhile modes of transactions used to involve papers, which had a lot of bad delivery taking place. You always had a lot of forgeries taking place, for example. But with the repository and the ENWR, it becomes very easy, and the buyer is a lot less worried when he's buying an ENWR than he's actually buying physical paper, which is backing certain physical commodities at some warehouse across the country. So this is something which is in a lot of ways similar to equity markets, but instead of a depository, you have a repository. Of course, you have the brokers, what we also call in Indian parlance as members, who are the people through whom the clients will open their accounts and trade on the exchanges. So this is in a lot of in a lot of ways similar to how the equity markets functions. The brokers are virtually the same. Most of the large brokers who are on the equity side are also members or brokers on the commodity ecosystem as well. You also have another unique participant, that's warehouses and assayers. So warehouses are actually physical structures where physical deposits of goods do take place. So the exchange and the clearing corporation notify these warehouses, and the list of warehouses which are where buyers and sellers can actually engage in physical delivery is put up on the exchange website. So typically a seller who wants to really give delivery on the exchange will look at the list of warehouses, identify the warehouse which is most convenient to him in terms of geography, in terms of preference, etc. And then through a warehouse reservation system, go and deposit the commodity in that particular warehouse. So when he actually goes to deposit commodity in that particular warehouse, he goes through a process of what is called as assaying. Assaying is basically ascertaining the quality of that particular lot of delivery. So for example, if you look at 10 metric tons of soybean, if it's not very easy for everybody to picturize how 10 metric tons of soybean looks like. But typically it involves around 100 odd sacks of soybean. And each of these sacks are, there's a sample taken from each of these sacks or gunny bags. And then the sample is sent to a lab. These are all NABL accredited laboratories across the country, where the sample is tested. And once the sample passes the quality parameters which are put out by the exchanges, only then the electronic credit or the ENWR is created and transferred to the account of the depositor. So this is how the whole process of deposits takes place on the exchange platform. And hence you have warehouses and assayers who are very unique participants in this whole ecosystem. Then of course you have investors and constituents and people who are participating on the exchange. I mean, like the equity ecosystem, you have various different types of investors. You have very sophisticated investors like say a mutual fund or an alternative investment fund, a foreign investor like an FPI or an FII. You have algos who are trading on the exchange platform, as well as normal retail participants like you and me. Similarly, on the commodity side as well, other than the foreign participation, pretty much every type of participant, I mean, a large set of the participants are allowed to come in and trade on the commodity derivatives platform as well. You have AIS who are permitted, you have mutual funds who are permitted, retail clients who are permitted to come in and trade on these platforms. And of course, you have a lot of VCPs or value chain participants, what we call. These are people who are associated with that particular commodity. So whether it's a jeweler in the gold derivatives market, or any refiner in the copper ecosystem, or any processor or manufacturer of edible oil or basin or corn feed, whoever it might be, they all come in and participate on the exchange platform. And last but not the least, we have the people who are actual producers, that's the farmers, who are also participants on the exchange platform. I mean, just an overview for the exchange, just a minute on this. We were, like I said, we commissioned in 2003, December 2003 was when we started. At present, we have 20 plus commodities in which we offer trading. A client base of, I think it's around 33 lakh at this point of time, 13 to 15,000 terminals across the country. And we have warehouse storage capacity of close to 1 million metric tons of storage capacity across the country that we have accredited for deposits and deliveries on the exchange platform. So on a monthly basis, we see actual physical delivery of around anything around 25 to 70,000 tons of physical delivery, which takes place through the exchange platform. And these are some of our stakeholders or shareholders, actually. Very large corporates and institutions and public sector participation as well, which is seen on the in terms of ownership on the exchange platform. And hence, to a large extent, although we are a for-profit organization, we are engaged in ecosystems which are very uh, I mean, like agri-commodity derivatives, which are very endemic to the economic need for the country as such. This is the broad group as such, and each of these group companies is one of the earlier stakeholders that I mentioned. NCDX, of course, is the trading platform. NERL is the repository wherein NCDX does, and NCCL is the clearing corporation. We also have something called NEML, which is a spot exchange. And spot exchange is completely different from the derivatives exchange, wherein the spot exchange does a lot of transformative work across the country in terms of modernizing the warehouses, or sorry, modernizing the mandis across the country. And they also do a lot of transactive work for various government agencies as well. So any auctions which the FCI needs to undertake with respect to the material which they have procured, they do it through the NEML platform. What Seema was mentioning earlier, we have a separate joint venture with the government of Karnataka. It's a 50-50 joint venture which we commissioned somewhere in 2014. And the primary objective was to modernize all the physical markets or the APMCs across the state. So that's the state wherein we have worked in sync with the government, state government out there, and we have transformed each and every physical mandi out there in the state. And one of the main benefits, there are a couple of main benefits of this transformation, or main characteristics of this transformation. The first being that the participation on this platform in the physical APMC before the transformation was limited to only traders from that particular APMC. Post transformation, any trader from any APMC across the state can participate in auctions of any APMC. So it's kind of opened up into at least a one state level market for that particular state. And the second benefit is that most of the transactions take place on an electronic platform again, and hence every commodity which comes into the mandi for sale goes through a process of assaying, and the appropriate grade for that commodity is identified, and then it is put on sale. Hence, the farmer is more often than not likely to get a better price for a commodity than he would from the physical market that you saw in some of the pictures that we showed earlier, where the participants completely relied on touch and feel and maybe taste of the commodity to deliver a pricing for that particular commodity. So this is in two ways, much more scientific, much more transparent market than any other mandis across the country that we have seen. In fact, the ENAM model was something which was developed. This was the base on which the ENAM model was developed. However, what we realized was that transforming a mandi is not really just about putting up a software for sale, for trading. It's much more about engaging to a large extent with the traders, explaining the benefits of actually embracing the kind of modernization that we were pitching for, and in fact overcoming a lot of resistance that we see that we really saw at that point of time. So it's a much more painful journey than one could envisage. And what ENAM maybe did was just try to put out the trading platform and expect that people will come in and trade, which is not necessarily always the case. So hence it needs a much more deeper engagement with the local mandi level traders for something like ENAM to be successful, in all honesty. We also have a few other group entities, like we have a entity which is focused on commodity education and research. So we do facilitate a lot of research through this entity. We are also promoters of an electronic exchange, PXIL. So this is also one of the entities which NCDX helped set up. And of course, we have something called an Investor Protection Fund Trust, which is used for various educational activities across the country. So this in a brief is about the company as such. And these are, in a nutshell, the various different types of people who come in and participate in these markets. Some of them are self-explanatory, but nonetheless, I'll just delve into each of them. You start with the farmers and FPOs. We never really thought that FPOs and farmers can come in and trade on these markets. It's a highly sophisticated ecosystem, highly sophisticated instruments. And while we yet hard to see individual farmers come in and practice and trade, but we are seeing continuous participation from farmer producer organizations. As collectives, these kind of bodies are now flourishing at various parts of the country, and it's one of the government's key objectives that they have earmarked around a target of around 10,000 FPOs to be formed in the very short span of time. And each of these FPOs, at least a lot of them who are from the ecosystem of commodities that we offer trading on, are very closely associated with us and have been trading with us almost since 2015-16 as such. One of the examples that Seema started to talk about was about this FPO that we've seen in the state of Bihar, wherein it's the all women's FPO, and in a small backward area district of Bihar called Gulab Bagh, where they have been associated with us since 2015-16, and they have been successfully delivering corn or maize on the exchange platform since then. Every year, they come in and participate on the exchange platform, which is testament to the fact that it's, although the derivatives markets sound very sophisticated, if a set of women farmers from a state like Bihar are empowered enough to come in and participate repeatedly on this platform and give testimonials on the benefits that they have seen on this platform, then pretty much everybody can really come in and participate on these platforms. Of course, you have people who are very closely associated with the commodity ecosystem, like processors. Anyone who buys any commodity transforms it through any process, either crushing or transforming it through any other process, and brings out to other commodities. So whether it's transforming raw cotton into cotton bales, or it's transforming chana into besan, or it's transforming mustard seed into mustard oil and mustard meal. Each of these has a very strong association with the ecosystem, and they are large participants on the exchange. Exporters and importers for some commodities. Some of the commodities that we trade on are very unique only to India, like the spices, for example, jeera, turmeric, coriander. These are commodities which do not have any other derivatives market anywhere in the world. So we are the only people who are large producers, large growers, and most of the people who export and import out of India really use these markets to trade. You have, of course, temporary holders of commodity like traders and stockists trading on these platforms. At times, we have government agencies come in and trade as well. And of course, you have various sophisticated traders. The next set of traders are all sophisticated traders, like you have jobbers, alternate investment funds, proprietary traders, quantitative traders. You have algo desks also in the derivatives market. So you have all types of traders who are pretty much synonymous with the equity ecosystem, also being part of the derivatives ecosystem as such. And this is the basket of commodities which is available. So you have everything from, in the agri side, you have everything from oil seeds to grains, pulses, spices, fibers, meals, and some very unique commodities like guar gum, guar seed, mentha oil, isabgol. I don't think you see this kind of wide array and basket of commodities anywhere in any exchange across the world. So normally, if you go to any exchange in the world, you see soya beans, soya oil, sugar, corn, wheat. These are the main commodities which are traded. But spices, for example, are not traded anywhere. Pulses are not traded anywhere. I mean, things like guar, which are only grown in India, and India is the largest producer in the world and exporter in the world. These are not traded anywhere. So that's in that way, it's a very unique bouquet of products which are available. And some on the non-agri side, we have energy is one of the largest baskets which is available. Crude and natural gas. These are very widely traded in the Indian ecosystem. Gold and silver, of course, Indians always have a very high appetite for consumption as well as trade in these commodities. So these two commodities do also attract a lot of trading interest. And of course, all the other base metals, aluminum, nickel, copper, zinc, etc. These are also pretty widely traded on the exchange platform. Now, if I might just step into the need for having these markets, and some of it is already something which I have spoken about. I mean, these markets really provide any business organization the way to mitigate the risk on the exchange platform. It helps them to get rid of the risk that they are associated with on account of volatility of prices. Like if you look at the equity markets, the main reason why you have equity markets in any economy is that it helps people raise money or raise capital for business. And for you and me investors, it helps people channelize our savings and get better returns than we would in any debt instruments or any bank deposits, etc. So people with risk appetite invest in these markets, and people who are entrepreneurs use these markets to raise capital and create huge business houses. Derivatives market, on the other hand, helps price discovery within the economy by having a pan-India contract which is trading available for trading. And it also helps business organizations to mitigate the risk which they are exposed to. Any large organization which is not hedging is actually speculating. So that's the basic premise that one ought to understand. If you are participating on an exchange platform, very often people associate derivatives markets with speculation. I mean, you've had this famous statements like entities, even large, very renowned people like Warren Buffett call them as weapons of mass destruction. But one ought to be mindful that these weapons of mass destruction are the very sophisticated derivatives which were put up at that point of time in 2008 in US economies. Here, what we are talking of is very simple futures, and simple futures are the essence on which large organizations ought to base their risk management strategies on. And any person who's not using these markets, any person who's not hedging their risk on these platforms appropriately, is actually speculating, because he's actually either sitting on inventory and hoping that the prices move in his favor, or is looking to buy something 3 months down the line and hoping that the prices come down 3 months down the line when he's actually transacting that particular commodity. So it's imperative that people understand the need for these markets. People understand the difference between speculation and risk management and adopt these markets. In fact, way back in 2006, 2007, when there was at that point of time as well a rally in wheat prices, and there was a global shortage of wheat even in 2006, 2007, the similar kinds that we are seeing today. At that point of time, the government of India also had used derivatives markets to hedge their risk, and they had at that point of time traded in options on the CBOT at that point if I'm not mistaken, in 2006, 2007. So everybody from the government to large entities has to use these markets to hedge their risk. It's similar to what people do on the currency side. Any large software company, if you looked at the earnings of software companies, say 15, 20 years ago, every time the rupee weakened, the software companies would earnings would really improve, and every time the rupee strengthened to a certain extent, the software company earnings would take a beating. And that's primarily because they had very limited exposure to hedging their currency risk, and they were to a large extent dependent on dollar earnings. But over the years, they have understood the need to hedge. they have de-risked themselves by hedging the currency fluctuations on the markets, and they make money out of providing business software solutions to their customers. So rather than try and make money out of volatility in your earnings or the currency of your earnings, you try and make money out of giving better solutions to your customers. And primarily, that's what we keep telling large organizations and large corporates, that your job is not to hope that the price of a commodity moves up or moves down. Your job is to just transform that commodity, make sure that it reaches most efficiently to the end user, and make the money out of transformation rather than out of price movements. So that in essence is how we place these markets as such. So in absence of these markets, we've seen that large organizations can suffer severe losses. And that's primarily what I was talking about when I referred to the quarterly statements put out by Adani, wherein they have been transparent about the fact that they are unable to hedge the risk that they ought to be hedging because of lack of adequate hedging instruments at this point of time. Ultimately, what happens is that when a company really takes a beating, when the prices really get volatile, these companies then go belly up, and they result in large NPAs, and banks and ultimately investors in these companies as well as these banks have to bear the brunt for that. Ultimately, it's the taxpayer who's bearing the brunt of people's reluctance to hedge, or people being extremely speculative and extremely trigger happy in taking price views on particular commodities. RBI in its circular dated 2015, and it's been a long time. In 2015, they had advised all banks to encourage large borrowers of large agricultural borrowers to hedge their commodity prices. But after 2015, they have not really gone further on their advisory and converted that advisory into a mandate. What would be advisable was that at some point of time, you transform your advisory into a mandate and expect that all borrowers, at least above a particular threshold, ought to be adequately hedged, at least in markets where hedging, or in places where hedging is available. So that's something which they have not yet taken up for various reasons. And the LODR requirements of 2015 also requires that various companies put up their price risk and hedging activities in their annual report. So this is a very positive move which is put up by both the regulators, but there's little more that can be done to take the next step in each of these moves. So this is something that we ought to look at. So these are some of the typical use cases on how corporates and how organizations use these platforms, and maybe we'll give an example of how even FPOs are using these platforms and to hedge their risk on their exchange. So typically, everybody knows about how people can make money out of markets. People can, the way Indian markets are growing in terms of the number of demat accounts on the equity side and the volumes pretty much every expiry we're hitting new highs in terms of volumes and participation on the exchanges. So that's very encouraging. So everybody knows how to make, or at least everybody is trying to make money out of equity markets. But hedging is a completely different ball game. Hedging is actually trying to make sure that you are not making any money out of price movements. It ensures that you are neutral to any movement in prices. So whether the price goes up or price goes down, I'm looking to locking in my price for a commodity. And hence you are insulating yourself from any movement in prices. So anyone expected to be hit by price swings in the commodity, anyone exposed to any kind of price swings in the commodity, need to hedge. And some of the common participants who really need to hedge: processors, traders, stockists, farmers, etc. So take the case of a farmer. A farmer who's sowing soybean will sow soybean sometimes in the month of June or July. That's the time when you typically sow a kharif crop. And then he waits 3 months for harvest. So harvest will take place sometime in October, late September, October, November. In these 3 months, he's exposed to incredible amount of risk. The risk primarily first comes from the from the side of nature. Rains, lack of rains, like what we are seeing this year. These are some of the typical risks that the farmer is exposed to. But if the crop fails, he still has some amount of protection. The government is there to stand behind him, and it has given him various forms of insurance with respect to crop failure. And if not even insurance, the moment there's a crop failure, there's a declaration of a drought, some or the other aid will come from various government agencies and make sure that he's not left high and dry. On the other hand, if his crop is good and pretty much the crop is very healthy all across the ecosystem, he now is exposed to something which he's not prepared for. He's exposed to the price actually going down at the time of harvest. And that's something that we have seen, and I'll probably run you through a couple of graphs later on. Typically, what happens pretty much every year is that the price at the time of harvest is much lower than the price at the time when the farmer has sown his produce. And hence, this interim 3 months wherein he works very hard to ensure that the crop is healthy and stays good, when he takes the produce to the market, he's actually getting maybe 20% lower than what he expected. Similarly, everyone who's actually buying and holding the commodity for any period of time, whether it's a trader, a stockist, a processor, everyone is exposed to the volatility in prices, and prices can be pretty volatile. So if you look at it, a recent example, a commodity like jeera went from around 18-20,000 rupees a quintal to around 35,000 rupees a quintal in the last season. That's 22-23. And in 23-24, we have already seen jeera go from around 35,000 rupees a quintal to around 65,000 rupees a quintal. This is the kind of volatility that you see in terms of prices. And if you are on the wrong end of this price move, then you are really completely wiped out. If you look at the international scene, I don't know how many of you would recollect in the year, in the months post COVID, there was almost a global shutdown. And at that point of time, since nobody was getting out of the house, no planes were flying, not much trade was taking place, the price of crude had actually plummeted to levels that we had never even dreamt of. So the price of crude, which is now around $90 a barrel, at that point of time, it had gone negative $38 or $37 a barrel at the time of one particular contract expiry. If I'm not mistaken, it's the April 20 contract expiry for crude in the US. The price went negative. That means the seller had to pay the buyer $37 to buy a barrel of crude. It's something that we cannot really envisage. And this negative pricing lasted for a good couple of trading sessions on the international markets. So these are the kind of abrupt disruptions that one might face in trade at any point of time. Of course, COVID disruptions are completely black swan events. It may be taking place. I'm hoping that it takes place only once in our lifetimes. But these are the kind of disruptions that one needs to be aware can take place in commodity markets, and one needs to be prepared. And the only way to be prepared is that you take a opposite position and hedge yourself on the exchange platform. The advantages of hedging is that everyone has a core competency. So for example, the farmer, the core competency of a farmer is to farm. He sows, takes care of his crop, manages his crop, makes sure that he's spraying it timely, protects it from various insects and birds, etc., wild animals, etc. That's his core competency. His core competency is not thinking that this year jeera looks 65,000, next year it might go to 150,000. So I'll take advantage of that. I'll sow jeera. That's a speculative mindset. But if he just focuses on his core competency, making sure that he does what is his main job, that's something which will really benefit him. And the advantage of hedging is that it helps you to focus only what you are really specializing in. Processor can focus only on transforming or crushing that particular commodity. He brings all kinds of efficiencies into the whole transformation process, bringing in efficiencies of scale, bringing in more efficient supply chains to make sure that he gets his input and reaches the output in time to the customer. So that's what he can focus on, and he can be completely insulated from price volatility. So in a way, these instruments are like insurance. And when we do that, when we look at the way that farmers have been using this, it's very close to insurance. It completely takes away the headache that you have or the tension that you have with respect to price volatility. So how do various entities take different positions to manage their risk? So a long processor, long hedge by a processor who is looking to buy a commodity at a future date. So I'm a biscuit manufacturer. I'm ITC. I'm manufacturing biscuits. I need 10 metric tons of sugar every month at my factory. So he will take it off. I mean, the risk that I am exposed to is the fact that the price of sugar might go up at some point of time in the future. And the only way I can offset that risk is by taking a long position on the exchange. The moment I take a long position on the exchange, if the price of sugar goes up, I will end up paying more to the sugar mill, but I'll make a mark to market on the exchange platform, and hence it will be mitigated. These two will knock off each other, and I am locking in my price by just taking this long position. In a very simplistic way, this is how any processor will hedge their risk. Similarly, a short hedge, someone who's sown soybean on the in the month of June. Now he is exposed to 3 months of price movement and the prices in terms of October when the actual crop hits the market. He will take a offsetting short position on the exchange platform. The only risk that he has is that the prices might crash by the time he's harvested his crop and taken it to the market. So if the prices actually do crash, he makes money by the short position on the exchange platform, and he is selling it at a lower price in the physical market. So this is a very simple example of how a farmer can use a short position on the futures. Of course, the more useful strategy for the farmer is to buy a put, but we'll take that a little later. The other thing is the short hedge by a processor who is sitting on inventory of a commodity that he has procured. So everyone sits on some inventory or the other at any point of time. No one can run, I mean, not many can run just in time processes in their workshops or in their factories. And the risk that he's taking, he can offset it by taking a short position on the exchange platform. So he's long physical, that means he's sitting on inventory, he's long physical, and he takes a offsetting short position till the time he is sitting on a long physical on the exchange platform. And the last thing is about farmers using options to hedge their risk. And this is the most viable way that the farmer can use a derivatives platform. Buying a future is a very capital intensive option, in the sense you have to pay mark to market on a daily basis, and the margins are also relatively high. But buying a put option is something which is a one-time cost. It's like very akin to buying insurance. You pay a certain premium, you buy a put option. So a farmer who sowed soybean at the end of, say, June, he buys a put option for the month of November, which is the harvest time for soybean. And he buys it for the strike at which he's comfortable selling that particular commodity. So, for example, if the price in the month of June is around 7,000 rupees a quintal, he's happy with that particular price, he buys a 7,200 rupees strike for October, and he pays a certain amount of premium, which is around 3% or 3 to 4% of the price. So he pays that premium and he buys that particular put option. Now he's not worried whether the price goes up or price goes down. If the price goes up in the physical market, his premium is kind of going to go worthless. I mean, his option is kind of going to expire worthless. But he can very happily go and sell his produce in the physical market at whatever is the price, 7,500, 8,000, whatever it might be. But if the price crashes to say 4,000 or 5,000 or 6,000 rupees, then if he goes to the physical market, he ends up incurring a loss. But on the derivative side, his premium value actually increases. So he can liquidate the premium at an increased price on the exchange platform and go and sell the produce in the physical market, thereby neutralizing his losses. Or he can actually tender delivery on the exchange platform and thereby realize the strike at which he has bought the put option for. So these are two strategies that he can use. So what he is doing effectively by paying the premium is that he is ensuring that he has all the upside. So the moment the prices go above 7,300 or 7,400, he has all the liberty to go and sell in the physical market, and he can just forget about the option that he has bought in. or the moment the prices go down, then he can either exercise on the exchange platform and tender delivery on the exchange, or he can liquidate on the exchange platform by selling it and going and physically delivering it on the in the physical market as such. So these are two options that he has. Now this is something that that makes a lot of sense for farmers, because they can completely liberate themselves from the pricing fears that they have with respect to their produce. And we have been promoting this for a long time, and in fact this is something which can be used by various government agencies as well, because today what you're doing is effectively to safeguard the interests of the farmers, you declare MSP and you engage in procurement at MSP at a very high cost. The cost of procurement at MSP is not only the money that you're paying to the farmer, but also the fact that you are engaging in this exercise of buying the produce, storing the produce, and then at some point of time liquidating that produce. So while this is absolutely necessary for certain amount of material, because you need that amount of material for all your PDS distribution needs, you end up buying much more than that. So for example, around 30 odd million tons of wheat is 30, 35, 40 million tons of wheat is the buffer stock, or the stock which is procured by agencies like FCI for on an annual basis. In the last couple of years, it has come down, but typically this is the range of stocks that these agencies keep. The the annual PDS requirements are much lesser than that. So if you can just focus on physical procurement of only the PDS material, and for the rest of the material wherein you have to give some kind of price support to the farmer, you can give him a direct transfer, or give him the money to buy a put option on the exchange platform, and that kind of gives him enough insurance so that in years wherein the crop is very healthy and the prices are depressed, he is not impacted to that extent as he is today. It's a very cost efficient way of reaching a much larger section of the farming population than what you're doing by PDS procurement, because PDS procurement, you're only reaching around 30-40% of the farmers in very select geographies across the country, and only for two commodities. Effectively, you're doing it only for rice and wheat, and maybe occasionally for a few pulses and a few oil seeds, but you're reaching a very small subset of population. So this is something that we've been pitching very strongly, and we've been getting very positive feedback from the government agencies as well, that this is something that is at least worth an experiment, and we might see pilots on this going forward. So this is what I was talking about. The farmer's income is a function of yield and price. The yield is to a large extent covered by insurance. If there's a failure on account of drought or excessive rains, then crop insurance is something which is there. And this too was kind of subsidized by the government for a long period of time. But on the price front, there is absolutely no protection if the price falls. And this is where put options can come in very handy. So on the insurance front, there's a budgetary outlay of around 15,000 crores by the government. And these are dated figures, I think about 2 years back, not really contemporary figures. So this is a kind of a depiction of how prices, this shaded area, if you are able to see, is the sowing and the harvest period. And very often you will see, like in the year 2018, 2017, you have very strong falls during the sowing period. What that depicts is that the farmer is looking at one price at the time of sowing, and the price that he realizes at the time of harvest is completely different. This is a commodity chana that we have taken, and the center of Bikaner. So if you look at it in the 4 or 5 years that we have depicted down in the table, there's a 26% to 52% volatility that we have seen in some of these years. So farmer is actually getting 50% lower than what is the price that he had planned for at the time of sowing. It's kind of very cruel on the farmer. It's kind of a very bad joke on the farmer when this happens. And put options can come in very handy in these kind of situations. And it kind of gives the farmer a relatively sound peace of mind when he is completely deleveraged from the price volatility that is currently facing as such. So this is another commodity. In mustard also we see that anywhere between 10 to 20% is the kind of price fall that we had seen across the years. These are like for the last decade we have seen price movement from 2010 till 2020. So this is something that can be addressed through price options. So I mean, and this is just a depiction. Today government is announcing MSP for various commodities. It announces for around 20 odd commodities, 22 commodities across the spectrum. But only rice and wheat farmers out of select geographies can sell their produce at mandis. And that also part of their produce. Rest of the produce they have to sell at market rates. But if they do provide options, then they really can do much more, reach much more farmers and reach have a much wider acceptance of this particular instrument. So the main payoffs in terms of option, if before expiry the market price is higher than what the strike price for which the farmer has bought the option, then he can sell the goods in the physical market, or he can and he can let the position either go worthless, or he can square off the position on the exchange platform if there is any residual value left. On the other hand, if the market price is much less than the strike price, he can either deliver on the exchange platform, or he can actually liquidate the option on the exchange platform and then go and sell in the physical market. So that's something which is an option. Ultimately, it's an option instrument. So this is where the absolute beauty of an option lies in it. It does not mandate anything on the farmer. It just gives him the options. And in the true sense of the word, it's really a very, very well put together instrument as such. It protects the downside. Upside is completely limited, unlimited. So the price can go to 8,000, 10,000, 15,000, 20,000. Doesn't matter. The upside is unlimited. So, I mean, and one must understand the difference between a future and an option. In the future, when you sell at 8,000 rupees a quintal or 7,000 rupees a quintal in the month of June, ultimately the farmer is stuck at that price. If the price actually goes up to 10,000 rupees in the physical market, the futures will also go up to 10,000 rupees. So on the futures, he will make a loss of 3,000, and on the physical market sale, he will gain 3,000 rupees. So net, he's locked in a price of 7,000 rupees. So he's completely neutral. Whereas in an options instrument, just by paying that 2% or 3% premium, he can participate unlimited on the upside, and on the downside, he is limited to 7,000 rupees a quintal. So that's the beauty. He's fixing a price, yet enjoying the benefits of the upside. So this is the beauty of an option, of course, and there's nothing better than that for a farmer. Now on the exchange, in addition to talking about this a lot and doing a lot of advocacy, we had actually run a pilot program for this particular instrument, and we did it in two commodities, in chana and mustard. So we did around 3,000 metric tons of these two commodities, around 3,010 metric tons, around 2,000 tons of mustard and 1,000 tons of chana. In all, around 41 odd FPOs did participate on this exchange platform. Just 1 second again. So we had around 40 odd FPOs which did participate on the exchange platform, and 25 unique writers who had written these options for these FPOs. The cost of option at that point of time was around 5 to 6%. It's slightly higher, but still it is much lower cost of operations than running a procurement program like the ones which FCI does. And over a period of time with larger participation, we expect the options premium to be around 3 to 5% as such. And total number of so this was a very successful pilot at that point of time. We were envisaging much larger pilots to be run across the country. This was only for a very small quantity. First time that we were running something like this, we had around a very small budget for this at that point of time, and we did around 3,000 tons, which was fairly healthy, but not great. But we have much larger plans for this. But the Downside subsequently was that some of these commodities got delisted, and in the current scheme of things, with the commodities that we have, we do not envisage great participation. We need large commodities like chana, mustard, soybean, wheat, etc., wherein we can execute these kind of programs and reach a much larger and much wider subset of FPOs and farmers across the country. That's something that we are really looking forward to at some point in the future. We also put a lot of skin in the game for FPOs and farmers. We do give a lot of subsidies for the costs which are incurred by them, especially with respect to physical delivery. So, cost of bags, for example, transportation from their farm to the warehouses, brokerage charges, mandi taxes, etc. All of these are subsidized by exchanges, uh, thanks to guidance by the regulator, especially because they have kind of put their skin in the game and foregone some of the fees that they normally charge exchanges, and that is the fees which is used by exchanges to do this kind of subsidy. So it's really thanks to the regulator that we are able to do these kind of things. Now, this is a simple interaction with respect to how trading takes place on the exchange platform. It's very synonymous with what happens on any financial market, equity markets for that extent. Client interacts through the broker with the exchange. Broker, of course, interacts with the clearing member, clearing banks, etc. They interact with the clearing corporations. In place of a depository, you have a repository participant and a repository. So, in case there is physical leg to the transaction wherein physical delivery does take place, the client goes and deposits material in the warehouse. Once deposited and approved, he gets an electronic credit through the repository into his electronic account, remat account with the repository participant. And upon delivery, he can actually transfer the repository ENWR to the counterparty upon physical delivery of the commodity. So this is in a nutshell of the entire flow of transaction which takes place on the exchange platform. And while I have spoken about it much earlier as well, so some of the important attributes of these kind of markets, price discovery, of course, goes without saying. It's unbiased price discovery mechanism. Price dissemination also as important because spot and future prices are constantly disseminated by the exchanges. You can subscribe through it through an SMS feature. Various sticker boards at all the APMC mandis have the exchange prices put up on them. So there's various media today wherein you can gain these prizes as well. Risk management, of course, I have spoken about it. And if what it ultimately ensures, effective risk management ensures better asset quality for banks. You see a substantial reduction in NPAs, and this is why we are constantly engaging with banking regulators, banks as well, so that they mandate their borrowers to make sure that they are appropriately hedged. At the end of the day, it's the overall economy which benefits when there are lower levels of bankruptcies in an economy. It's of course like any other exchange. This is an exchange which gives counterparty guarantee, and it has to a large extent helped a lot in infra creation. Now, one of the things that I failed to mention is that we are probably the only platform which adheres to quality specifications in the agri ecosystem, other than people like, of course, end producers like Nestle and Tata's and any end producer of a branded commodity. In the primary market, raw commodity which is procured from the farm, we are the only people who ensure that the commodity meets with all the laws of the lands. And by laws of the lands, I mean acts like FSSAI, AgMark, pretty much any quality specification which is mandated by the government. We ensure that the material which flows through the exchange warehouses adheres to these quality specifications. Hence, we have a very strong network of assayers, very strong network of warehouses across the country to not only ensure that the material which comes into the warehouses adheres to these specifications, but also to the extent that in the time that the material lies within the warehouses, the quality of warehousing is such that it ensures that there is no deterioration in terms of in time of storage as such. So the quality of warehousing which is adopted by the exchanges is a world ahead of what is normally seen in the physical space across the country in the agri ecosystem. It's completely transformative in terms of how the warehousing is handled in any exchanges platform. Of course, like any other like any other business, we have our own set of complications as well. It's if you compare it today, India has adopted very, very well to the equity asset class. More than equity, it's equity derivatives which are driving today. And you see that in terms of the participation, in terms of the volumes, in terms of the demat accounts open across the country. And commodity derivatives to that extent are a much, much more complicated asset class. It requires a lot of understanding, not only of the inherent fundamental features of that commodity, but also in terms of things like shelf lives, how long the commodity can be stored, how long, what is the seasonality, then the logistics involved in terms of giving and taking delivery, the local laws, etc. So it's a much more sophisticated and a little more complicated asset class, and hence the retail participation till now has been kind of limited. We ourselves have not done enough of advocacy and education, and that goes for all the stakeholders. We do a lot, but much, much more needs to be done in this sense. It's also a very politically sensitive asset class. As such, whenever there is a spike in inflation, people start looking at exchanges and start wondering what's happening out here. But the fact is that any commodity today, in fact, the most talked about commodities in the last few months have been tomatoes, onions, potatoes, top. None of these are traded on commodity derivatives platforms. In fact, the volatility has been inherently proven over the years that the volatility in commodities which are traded on the exchanges is much, much lower than those which are not traded. If you remember, I mentioned about Urad and Tur being delisted in 2007, 2008. After that, over the last 16, 18 years, we have seen that the volatility in Chana, which is also a pulse, is much, much lower than Urad and Tur. Urad and Tur have been much more volatile when they are not trading on an exchange platform. Similar examples have been seen across various baskets. In oil seeds, we have seen that those that are traded on the exchange are much less volatile than those which are not traded on the exchange. Hence, there is no need for political sensitivity as it is, and the constant interventions that we see today. But of course, this is something which will take some time, a lot of engagement, a lot of advocacy for these challenges to be overcome. Another challenge is the multiple jurisdictions. Agriculture, to a large extent, is a state subject in India. Warehousing is regulated by a different regulator. Trading platforms are regulated by a different regulator. So there are a lot of overlapping jurisdictions in this ecosystem, and that at times becomes a kind of a challenge. But it's also beneficial in a way because it's one of these markets where a lot of regulators constantly put their minds together and try to see how we can make things simpler and make business much more easier to undertake. So these are some of the challenges, but these are also some opportunities for us to take these markets to the next level and make it better. So with that, I think I have, I'll just touch upon some misconceptions that are there on these markets. So one of the main misconceptions is that these are all speculative markets and there's not much delivery taking place, but we have very, very strong network of deliveries taking place. We've actually done around 1 crore tons of deliveries on a small platform like ours since inception. We have multiple delivery centers across the country, so delivery can actually take place from multiple centers. Quality is always an apprehension, but till date we have never had any major quality issues on our exchange platform. We try and adhere to, in fact, mandatorily adhere to FSSAI AgMark compliant quality specs, and we are very proud that till now we have not had any quality related issues as such. Farmers who typically most people will associate with not being savvy enough to participate in these markets. Today we have actually more than close to 12 lakh farmers who have actually associated and participated on these exchanges. And lastly, like I said, we do not really contribute to volatility. In fact, we are the protection against volatility, and we help participants actually hedge themselves or protect themselves out of volatility. So that's my limited take on these markets, and I hope I have added some amount of I've added some value in terms over the last few minutes that I've been speaking out here. So thanks a lot, and I kind of leave it open to questions at this point of time.
Thank you, Avinash-ji, for your session. You're not spoken for a few minutes, probably a few hours, on such a crucial and difficult topic, on the commodity derivative market. Thank you. Thanks a lot for this.
And I also, once again, apologize for the couple of interventions. I am unfortunately alone at this point of time at home, so unavoidable interventions. Please accept my apologies for that.
No worries, sir. No worries. I'm just checking with Seema ma'am. Are you available, ma'am, for question and answer?
Yeah, I am.
Great, ma'am. Great, thank you. Definitely, both the speakers has touched upon very sharp and very comprehensive manner on this difficult question. But on this question, difficult topic. But there are equal difficult questions from the participants who are attending across India or across globe, for this session. While as a panelist, you can use the 2 lines of Shair, which says that किसी को अपने अमल का हिसाब क्या देते हैं, किसी को अपने अमल का हिसाब क्या देते हैं, और सवाल सारे गलत थे, जवाब क्या देते हैं. So, but I'm very sure you will be happy to take this each and every question. And now I move to the questions which are asked by the participants. Ma'am, my first question is on the overall this commodity derivative market. I have seen the history. Mr. Avinash also covered it, briefly. But there are some hiccups to that journey. Sometimes we see government bans also on some commodities, then they're lifted on. There is one lobby which is in favor of this commodity derivative market. There is also equally a strong lobby which is opposing this kind of market. My question to you, ma'am, why as a policymaker or government or professional, we are not able to settle this debate and give a stability to this kind of market?
ऐसा है हिमराज जी, आपके सवाल में ही आपका जवाब है. So where is the opposition coming from? Where is the opposition to all this coming from? See, there are 2 aspects to the entire opposition. One is from the policymakers, right? And the other part, let me take the example of the farm laws. कहाँ से opposition आया था? पंजाब से opposition ज़्यादा आया था. And that area, north se opposition zyada aaya tha. So, there are probably not the right, forum to kind of, and these are my personal views. I must first upfront put that disclaimer. These are not the views of NCDEX, and so that will allow me to kind of be more candid. So, the transparency, Avinash explained in very detail as to what the exchange mechanism is doing, right? Foremost, it is bringing in transparency in the process of price discovery. It is transmitting the prices to the ends of the nation. Who would not want this? अगर हम equity markets का जो मैंने example दिया था, उसमें जाते हैं, तो जो मैंने बोला था कि पटना का broker है, आपको लगता है वो खुश होगा कि transparency आ गई है, उसका तो मतलब job ही redundant हो गया. So, these are the people who are in the, मैंने आपको example दिया वाशी मंडी का, जहां पे 5 रुपए में जो आलू बेचे थे farmer ने, that came to us at ₹30. The chain in between, do you think they would want any transparency in the markets? So these, there will always be, and any change will bring about resistance. But this has been such a long period, and there are interested parties. I would just like to, without going into too much detail, I would like to just say that it is politically convenient to kind of oppose the derivative markets. I don't think we have had detailed interactions with the policymakers. They definitely understand that the market is for the better of the economy, etc. But when it comes to political convenience, it is very inconvenient to support the markets. That's more of the thing rather than anything else. If you look at the stakeholders, I think all the stakeholders are convinced about the markets. There would be one aspect, one part of, I don't even know whether we should call them the stakeholders. So the mandis sometimes, opposed to it, because जहाँ पे आप handkerchief के नीचे price determine कर रहे हैं, वहाँ अगर price में transparency, so that kind of, that process will definitely not be possible if the markets flourish. But in one of the sessions that we had done, I had received this question, and I'm preempting this and giving you an answer for this. So somebody had asked me, Madam, unki jobs, their ability to earn is not important. It is important. You think, that Patna wala guy is still, not doing anything. He would have become an AP. He would have become a sub-broker at that point in something, right? So we have seen the transition happen in the town of, in the remote towns of Rajasthan, where we have our participation. What the commodity exchanges are actually doing is they are taking the markets to the remotest hinterlands of the country, right? And we have participation from, small, जिसको कस्बा कहते हैं, on the border of Pakistan, etc. These are the people who are participating. And yes, what we have seen there is those Artiyas have actually had taken broking memberships, because see, they are the ones who are connected with the markets, right? And I'm happy to say that in some cases, my BD teams would have handholded them into it. So it's a matter of transition. So that's what it is all about. There is actually, to my mind, no opposition from the participants of the market, the stakeholders of the market. But yeah, sometimes it's the political convenience which makes it easy. आपको कोई ना कोई action लेना है, आपने derivatives को ban कर दिया, आपने action ले लिया, आपका tick mark हो गया, something like that. And that is something that, we've failed to kind of take it across to the regulators that, what you're doing is creating a much deeper impact than just immediate banning of the product. And Avinash also kind of alluded to that, how it kind of completely destabilizes the markets.
Thank you, ma'am. Avinash ji, coming to you, India is hosting the G20 meetings, today and tomorrow, and government also has promised to double the income of small farmers, especially. How this commodity derivative market will add specially to these small farmers? My question to you: how this will benefit the small farmers? Because these markets, understanding, knowledge, accessibility are generally seen to the big farmers. They are easily, they can probably form the FPO also and everything. How small farmers will benefit from such kind of markets, if you can throw some light on this question.
Okay. So the first way every farmer pretty much in the commodities that we trade has benefited is from the perspective of transparency. That itself empowers the farmer to better decision making. And whether or not the farmer directly participates or not, that benefit is now almost like a given. It's not really a benefit anymore, because that's a way of life. When we first went to the markets in, say, 2007, 2008, around that time, we were amazed to see that farmers were standing at various mandis and just looking at these sticker boards. And we just asked them what actually do they do? Do they trade in derivatives? They said, no. We know that this is the prices which are prevailing out here. So this guy can't take me for a ride and sell me, buy my material at 20% lower than this. I have a benchmark today which I can relate to, and that's the primary benefit. The second more important benefit which we are seeing today is that the farmers, however small the farmer might be, this example that I spoke about women farmers from Bihar, they are extremely small farmers, and the collectives which are coming up today are actually helping these farmers come together, get a voice, and get a seat on the table for themselves. So through collectives is the only way possible for the farmers, not really only for trading on the exchange platform, but for any other activity, getting seed at efficient prices,
getting fertilizers, reaching the right physical markets, the right kind of treatment for their plants, everything is done through FPOs today. It's something like how Amul revolutionized the entire ecosystem for milk in Gujarat and subsequently to the country. FPOs in a few years' time, in their own relative small geographies, will be transforming the way farmers conduct not only farming, but more importantly, pre and post farming, the way they take loans on collateral, the way they finance their own farms, and the way that they sell their produce, not sell everything in distress at the time of harvest, but gradually sell their produce is something that we're seeing today. So these are the instruments through which every kind of and every size of farmer will derive benefits going ahead.
Thank you, sir. Coming to you, ma'am. Coming back to you, ma'am. We have seen equity markets. You and Avinash just touched on that. It has become quite a popular thing, in India, even in tier 2, tier 3 cities also. We have seen during the corona pandemic, the large number of accounts, demat accounts are getting opened. Many brokers, they open account just with some OTP, KYC and other things also, And it has demat account or the equity market is become a word of every family, or every household, Why commodity market, is not become that much popular, and what kind of support do you think is required from the government or the policymaker to make it, common or accessible to everyone?
So again, the reason is because so when would you invest? Forget about the markets. When we invest, what do we look at? We look at stability, right? So if you're seeing bans, etc., how would you the stability in the markets is not there. So, and I think that is the major impediment. Like Avinash was mentioning about SEBI having coming in and, bringing in a lot of changes, right? So one of the things that they did is allowed mutual funds, right? So even when you're talking about the retail participation that has increased, a lot of them are also going through mutual funds. While I completely agree that during the COVID period, direct investments have also become, pretty huge. But the people who are not directly investing are very comfortable investing through mutual funds. So one of the things that we kind of put forth to the regulator is let's open that window, because there at least expert is kind of taking the decisions, etc. And they did open that window, and we did have a mutual fund participation. But again, once the ban happens, the mutual fund can get caught in a very wrong way, and the mutual fund manager, right? So I'm not too sure, right? That even after the products come back, whether we'll have to do a lot more convincing, and this time around we'll probably do the convincing with the regulators, right? So that's the biggest hit in getting the retail participation. To my mind, right? You don't have stability in markets, people won't come to your markets, and those are beyond our control. Those aspects that have happened are beyond our control. Other than that, I think primarily, commodity markets have been looked upon as hedging space, and it is only in the recent past that people are realizing the benefits of investing in commodity markets and kind of balancing their portfolio with equities, right? I'm sure even if you do a poll among the participants who are there, and we are all talking to CAs here, if you ask them whether they have invested in commodities, while some of them would have, and that would probably be gold and silver, because like Avinash mentioned, that is something that you're very comfortable with and we want to, right? Other commodities, they may or may not have, right? So we should also ask ourselves that question. Avinash and I are not allowed to trade in commodities, but the rest of you are. So I think that is one space that we are consciously working on. And one thing that we have done is, realize that, the idiom catch them young and watch them grow kind of a thing. So we're doing a lot of sessions across India, right from the, junior college level, so that as this breed, the next generation, the millennials, as we call them, they are very comfortable with taking risk, etc. Your generation and my generation, we were more safety oriented, and our fathers, definitely the previous generation was just FD generation. My father still doesn't believe in anything other than FDs, right? So which is of course giving negative returns, but he won't, I just can't convince him, right? So the next generation is definitely looking up, and that is where we are trying to educate and do the awareness sessions. So that is another part of it. We are hoping that you have to prepare for the next decade in this decade. So that's what we are doing.
Thank you, ma'am. Continuing with you only, ma'am. Somewhere in 2015, the government changed the regulator or consolidated the regulator for this. We had earlier regulator FMC, Power Market Commission, and now the SEBI is only regulating this market. We are also heading the compliance department at NCDX. How that changed the overall development of this commodity derivative market in India? Is it really helping out the regulator? The new regulator is doing really something for promotion and the development of this market, or that was just probably a clerical exercise done by the government?
This is a little difficult question, but I'll attempt, again, my personal views and not that the views of the NCDX. So I'll say, yes and no, both. Yes, it did help, and there have been certain challenges. So I think we have to kind of take it with a pinch of salt. Why I'm saying yes is a lot of things that that have come to the fore to improve the integrity of markets, as is definitely setting the ground for tapping the potential of the markets. If I have to give you a couple of examples, like I said, they allowed the entry of FPIs, they allowed the entry of mutual funds. You need to have a variety of participants, right, in the markets. You cannot restrict it to a couple of stakeholders and expect the markets to boom, right? So that's not going to happen. Again, they were very, very conservative, and they did, in many things, they've said not for agri markets, etc. But at least they made these beginnings. So they have strengthened the regulations. They have built up the base for kind of getting additional participants. They have allowed us to introduce the multiple basket of products. You need a basket of products, varied basket of products. The options were started under SEBI. The indices were started under SEBI. So yes, all that has definitely helped. But I'll stick my neck out and say something that I wouldn't want to be quoted on. But there is this tendency, because you've seen the equity journey and you've seen the evolution of equity markets. So there's this tendency to kind of do a copy paste of the equity regulation to the commodity space, and that sometimes is very damaging, very, very damaging. And that has been the bane of this integration. And I think FMC, in that sense, the earlier regulator being only for commodity derivatives, wouldn't do that. However, it did take many, regulations from SEBI. However, it would kind of see what the applicability is. But this is one struggle that we are having, that, you copy paste those regulations to the commodity markets, and then they are not. The nuances of this market are very, very different, and the regulations need to kind of be aligned to those nuances. And that is ongoing deliberations, discussions that we are having with the regulator. We've made some amount of success. The other thing that happens, Hemrajji, is, when you do a copy paste, see the stage of the equity markets and stage of evolution of the commodity markets, we are at totally different stages, right? The equity markets, we are probably where the equity markets were about 20 years back. But you apply the same regulations to my brokers, and I'm especially talking about those who are not common to both equity and commodity exchanges. So those brokers that I talked about, towns like Ganganagar, etc., for them to comply with the norms that SEBI is making mandatory is becoming really, really difficult. And if I have to give you some stats, we had about 1,500 members in 2015, and 2016 is when SEBI integration became applicable, and we had 750 members at that point in time. So तब तो खौफ था, अब तो असलियत हो गई है. So that is something that is definitely ongoing dialogue, like I said. So these two things, equity markets had the benefit of how should I put it, for want of a better word, easier regulations as they were growing. Our markets do not have, they have the equity market regulations even when they are, not even started growing. So that's a challenge that the entire broking fraternity and to a certain extent, in certain aspects, the exchanges and the clearing corporations are facing.
Thank you, ma'am. It was a difficult question, but you answered it very, very smartly, So thank you for that. Avinash ji, I have next question for you. Recently as a product offering, the index or indices also started on the exchange. What is the experience on that? Is it really helping out? What kind of volume, liquidity we have seen on such kind of product?
I think it's very early days to talk about indices as such. So indices are kind of a amalgamation of multiple commodities, right? I mean, you need a very diverse basket of commodities in the first place, and you need the ability to hedge across futures and indices as well. So the equity side, indices work very well because you have a larger underlying basket, and there is a very good correlation between the basket and the index. And there's a lot of cross hedging between the index and the underlying stocks as well. So that way it flourishes very well. On the derivative side, as such, commodities are a very different ecosystem. Today, being a very broad asset class exchange, we have around 20 odd commodities which are listed on us. But typically, a commodity exchange would have 6 to 8 maximum liquid contracts. There's an exchange in Malaysia which has only one liquid contract, and it's a very, very large exchange, very profitable exchange. So every exchange has very small basket of commodities. So its commodity indices are not very liquid, not only in India, but not very liquid across the world as well. But I do believe that India, once we have the larger commodities back on the exchange platform, it makes a lot of sense for commodity indices to be liquid, because there's a lot of passive investment in markets these days. If you look at the way mutual funds have grown in India, the way today ETFs are growing in India, practically every fund house is starting an ETF. These are a lot of passive money coming into the market, which as a small retail investor, I'm not very happy managing my own money, and I've seen that I've burnt my fingers multiple times. So let the experts handle it. And indices are very good instruments for passive investors to come in and deploy their funds. So a long only fund, passive fund, from that perspective, I think that it has more potential in India than it has in international markets. It's just that it needs a wider set of commodities in the underlying to structure a good index, which is not available at this point of time.
Thank you, sir. I request all the participants, if there are any questions, please do post. Though we have limited time, but we'll take maximum questions that are possible during this limited time. Avinash ji, one more question. In 2019, the mutual funds or AIFs or PMS, they were also allowed to participate in this market. And probably, to my limited understanding, even now insurance companies are also lobbying with their regulators, so that they were also allowed to participate in the commodity market. It may not be in the agriculture, but probably the other commodity markets. Now, the participants were already allowed from 2019, and their participation, is it showing some green signals to the overall other participants also, or how the statistics is happening? If you can throw some light on this, it will be really helpful.
So there has been a reasonable pickup. From different sectors. So if you look at, let's go sector wise. So first thing, let's look at AIFs. AIFs have reasonably healthy pickup we have seen. If you look at mutual funds, we had a lot of expectations, but there are still some structural issues to be involved, to be sorted out in terms of the limitations on their participation, on how they come in and how they trade using a custodian as such. And these are some bottlenecks which are yet to be ironed out, and hoping that once that those things are sorted out, mutual fund participation should kick off. Then you had this earlier one set of entities called the EFE, or the external foreign entities. They really never took off in terms of participation. These were participants from international markets who had exposure to domestic Indian markets. For some reason, the structure in which the approvals needed to be taken for those entities, they never really took off. And insurance companies, banks, etc., they have a lot of underlying exposure through their clients on the commodity ecosystem. So it would be worthwhile for them to come in and participate as such. So we are very hopeful that they come in and participate on the platform. As of now, they do not have any explicit approvals from their own regulators. Banks and insurances both have their own regulators in place. So hopefully they should be permitted at some point of time, so they come and participate. Whether they come in and participate whole hog, or they are given selective participation at first in non-agri and subsequently in agri, that really doesn't matter. Face level entries are always welcome. As long as the door is open, it can open wider as time progresses. So let small trickles of participation start off, and then maybe eventually it will pick up across time. As of now, today, if you look at the broader investing community, we are so enamored with this whole equity market and the way it is performing. It's almost like a distraction that you have other asset classes available in the country. I mean, there is currency, nobody talks about it. Commodity, nobody talks about it. It's just one asset class. And at some point of time, you also see the weight of that participation on this asset class in terms of the increasing PE multiples, which are not really justifiable anymore for fresh investments. So it's all the more important today to look at other asset classes. A sensible investor will look at different places where he can deploy his funds, because some markets are just too expensive at this point of time.
Thank you, Avinash. Seema ma'am, the investor education and investor awareness also plays an important role for the healthy development of any market. And we are the stakeholders, or probably important stakeholders of this ecosystem, also needs to play that role. And the committee which is arranging this today's session, committee for doing the some or other way the work on the investor protection. I just want to understand from you the role which exchange, NCDX, or other MIIs are playing on the investor protection, and how the interest of the retail investor is protected from that. If you can just highlight on that. Ma'am, you're on mute.
Apologies. So there is so much focus on investor protection that, I think I can go ahead and say that probably almost biased in favor of investors, to that extent, the focus is there. So right from having an investor protection fund, wherein, for any defaults that happen at members, and the payments can be made from that. the kind of rules that we have for investor protection are unparalleled in international markets, right? So I think from an investor protection perspective, we're doing better and more, right? So if you want to get into what all we are doing, so the first part is, of course, more than the protection. I personally feel that the awareness part is more important, because you have to be first aware, rather than get done with the fact and then try to kind of cover it up, right? So the awareness aspect is something that the exchange is, all the exchanges for that matter, are doing up a whole lot of things. And I must tell you that, the social media has really helped a lot in this aspect. Otherwise, in the initial stages, we were like only dependent on the physical programs, and the COVID times really kind of enabled all these online sessions. Today also we are having one online session. So right now the kind of the physical location related challenges are no longer there. Having said that, in the agri commodity space especially, the kind of communication that we have, and having been on the equity side, I can tell you that the equity communication is probably same across, right? But the in the commodity markets, your what you communicate to the stakeholders and how you communicate to the stakeholders both change from stakeholder to stakeholder. So when we do farmer programs, it has to be on ground and at their location. It cannot be an online program. But that's not true with the other stakeholders. We're doing a lot of awareness sessions, and like I also mentioned earlier, right from the schools. In fact, we've even from the government perspective, we've been doing sessions with LBS-NA also, which is the training institute for IAS officers, and the local state training institutes that they have in every state. So we've been doing a whole lot of that, and that's, of course, the results will not come today, tomorrow. The investor protection, on the other hand, all these defaults, etc., are a function of the trading that happens on the screen. And as you're aware, that the commodity markets are not as the turnovers are not as high, the participation is not high, the markets are not as deep without this depth, etc. So we have lesser instances of those. Yeah, that's good. But that, like I said, it's a function of how your markets are behaving. And so we've not had too many instances of investor protection, but I can rest assured that, the kind of measures that we have in place and what we are doing. And I'll take just one more minute to, there are two types of things that can happen, right? One is investor could make a loss in the markets. There's no protection for that. But if there is the money of the investor, which is with the broker, what usually happens, and what based on the past experiences of defaulter members, the member who's also doing proprietary trade would probably be using, client tends to use the client's funds for his trade or for his other businesses, etc. And we call it misappropriation of client funds, etc. Those were the major triggers to just kind of cut the story short, right? So that thing in itself has completely been stopped, by upstreaming of funds. I'm not too sure if all of you are aware about it, but now what SEBI has said is that the members cannot keep the client's money with themselves. They have to upstream it to the clearing corporation. So the entire money is now with the clearing corporation, and the status of that money is available to the client. He just has to log in and check the status of his money. So that's the kind of level of transparency. Plus we have, I think we have an overdose of SMSs. I'm sure each one of you is receiving your funds and collateral balances on a weekly basis. So the problem with that sometime, and I keep raising it with the regulator, is that, when you have an overkill of information, people don't look at, I myself don't look at those SMSs, and therefore when something really happens, you've not looked at the SMS, and so you have not alerted, right? So there is a whole lot of things that has been done. In fact, in Gujarat, there was this instance of one of the brokers, or rather not even brokers, the APs or somebody kind of getting into this malpractice of sending SMSs, tips, as they call it, and getting people incited to trade on certain penny stocks, etc. we have started sending SMSs to all clients in Gujarat to be aware of these kind of tips that you receive, stock market tips that make you rich instantly. So yeah, there is a host of measures that are being done for investor protection. However, again, my personal view is that, whatever I'm putting in paper, social media, etc., the investor is behaving the way he wants to behave, and the person he listens to is his broker or his CA. So, that is one area I missed when you asked what the CAs can do. I can keep talking from the lamppost about all the measures that need to be taken, but I have realized that these are the two guys he listens to. So I'm appealing to you to kind of, ensure that the people who come to you for guidance are guided appropriately. I'm sure you're already doing that, but, requesting one.
Thank you, ma'am. And last question for this session to Avinash ji. There's one technical question, from participant from Mumbai. He's asking that in your opinion, who would be writing the option? So he's asking that the farmer will buy it for hedging, but who will ideally write this option? If you can answer this question. Sir, you are mute.
You're mute.
Yeah. So if you look at the financial markets, there are a whole set of participants who are very adept only at writing options. And typically it used to be very large broking houses, but now it has populated down, and even retail investors write a lot of options. Everybody for the last few years have been making money or thinking that they're making a lot of money writing options, because writing options is a very risky game. It's like literally buying and selling a future. The risk is unlimited. So on the commodity side, what we have seen is we have one set of participants who are the more financially savvy set of guys who write options, and that's very akin to the sophisticated guys on the equity side who write options. You also have certain algo desks, etc., who also do participate in algo trading and writing strategies. Then also we have this set of participation coming in from people who are VCPs, who understand the commodity, who actually have a price view on the commodity, and hence they are comfortable writing options. So that is another set of participants who I think is not very, they are more unique to commodity markets, and they do write options as well. So it's a mix of both this set of people who write options. So it's typically we have seen that the number of people writing options is much lesser than the number of people buying options, and that's the case in all asset classes. It's the same out here as well, but there is no dearth of people writing options.
Thank you, sir, and thank you, ma'am, for taking all these questions, in patient manner and answering them to the conclusion. It's now end of the session. That what we're having. It's 9 o'clock. We started on time. We are ending on time. But before I do that, let me put my concluding remarks and word of thanks for this session with your permission. I convey my sincere thanks to the Institute of Chartered Accountants of India and Committee for Financial Market and Investor Protection, that is CFMIP, for arranging this session. I also thanks to Chairman Sir, CS Nanda Sir, for always ready or always providing this opportunity to arrange such kind of interactive and session for all the participants. I convey my special thanks to Seema Nayak ma'am and Avinash ji, both learned speakers. You covered 3 hours, in such a fantastic way. Really, I don't have words, and I'm short of words, to convey my thanks. Difficult topic, but you covered it in very simplified manner. You covered the various global scenarios. What are the international perspectives? You've taken the practical case studies, and you answered each and every questions which are asked by the participants. I convey my special thanks to Mr. Ratnesh Mishra, who is from NCDX, who extended his full support and taken all these efforts for conducting this session. I also convey my sincere thanks to Secretary CFMIP, Shri Amit Agarwal ji, other staff of CFMIP, Mr. PD Gavar sir, Arpit ji, and other IT support team for constant support for this session. At the end, I convey my sincere thanks to all the participants who are joining across globe, for this session. during the session we traveled to various cities, right from Bikaner, Jaipur, Unjha, Patna. So speakers made us to travel, across India without any cost. So thank you for that as well. And I have these two lines for everybody, कि किस कदर शुक्रिया अदा करूं उस भगवान का, किस कदर शुक्रिया अदा करूं उस भगवान का, अल्फाज नहीं मिलते, जिंदगी इतनी खूबसूरत ना होती जो आप जैसे लोग ना मिलते. With this, thank you to everyone. We end this session now. Thank you.
इमरान जी, आपने इतनी अच्छी शायरी बोली है, मैं भी इंस्पायर हो गई हूँ, तो मुझे भी एक शायरी बोलने दे ही दीजिए.
Please ma'am.
इन मार्केट्स के लिए बोलूंगी मैं कि इन मार्केट्स के बहुत से इम्तिहान अभी बाकी हैं. इन मार्केट्स की असली उड़ान अभी बाकी है. अभी तो मुट्ठी भर जमीन नापी है हमने, अभी तो सारा आसमान बाकी है.
Thank you ma'am. Thank you.
Thank you,
Thank you
Imran
so
ji.
much.
We can end this session.
Thanks.